Good afternoon, ladies and gentlemen, honorable guests and speakers. Welcome to the 18th Tricor seminar. My name is Dr. Tony Lee, and I'll be your MC for this afternoon. First thing first, please be reminded to switch your mobile devices into the silent mode for the remainder of the event. As we're in the midst of the COVID-19 pandemic situation, your health and safety here is of the top priority for both Tricor and Hong Kong Convention and Exhibition Center. The venue here has adopted the most stringent preventive health measures following the guideline from the Department of Health, Hong Kong Special Administrative Region Government. While bottled water will be supplied unlimited throughout the event, unfortunately, refreshments will not be provided today. We do apologize for those of you who rely on it. On the other hand, we do offer certificate of attendance via email for those of you who attended the entire seminar this afternoon. So please don't forget to drop off your name badges as you're on your way out at the end of the seminar at the collection box. This year, we're celebrating the 20th anniversary of Tricor. Congratulations. In the year 2020, in light of the pandemic situation, new norms, pretty much touching all aspects of life, are witnessed, and in one of which is the quantum leap of applications and digitalization. And to that, this is exactly why we've chosen a topic for this year's seminar, digitizing corporate governance. And this is actually the first year we've also engaged virtual participants. So for the 1,600 of you dialing via the internet today, welcome to the seminar. Now please be reminded, Q&A sessions online is available throughout the event via Spot, our Tricor all-integrated hybrid meeting solution. Now, in a second, you might find something going on in the screen here with some animation. There you go. And you might be wondering, what's going on with the animation. Now, to go hand in hand with the theme of this year's seminar, we're actually providing visual note-taking services throughout the entire afternoon. What you're watching there is actually a live demo, live stream from Singapore. Now, the completed visual notes will be available, in fact, downloaded for you at the website, and you have 7 days, until November 20th to have them downloaded at your convenience. And speaking of the presentations, very exciting. This year, we have invited government officials, subject matter experts, industry elites, and of course, our in-house experts to help us explore and to expand our respective knowledge on this new and emerging, yet extremely crucial for business growth, this very important topic. And we're confident at the end of the seminar, you'll find today very informative, very impactful, and gratifying. So without further ado, ladies and gentlemen, let's kick off this year's Tricor seminar by inviting our CEO of Hong Kong, Mr. Joe Wen. Please come up here and address all of us with an opening remark. Ladies and gentlemen, please welcome Mr. Wen.
Thank you. How are we all feeling today? I feel good, except I feel like I'm dim sum seafood now. But first of all, thank you. It's not easy for you all to come here, and we appreciate your presence and your support as always. So, looking back 2019, 2020, there were such disruptions to our lives that even makes events like this almost impossible just a couple months ago. We were lucky that the pandemic situation improved a bit, but we were happier that we have a support here physically. And online, we have 1,500 online registered attendees at the moment as we speak, so hello. First of all, again, I'm honored to have Dr. David Zhong, Undersecretary of the Hong Kong's Innovation and Technology Bureau, and Professor Chan, Non-Executive Director of Tricor Group, to deliver a keynote address. And of course, my friends and partners from the stock exchange, from Deloitte, from Ernst& Young, from the FinTech Association of Hong Kong, the Hong Kong Investor Relations Association, Eva, hello, and also the Hong Kong Bit Exchange. Thank you for joining us. They will be sharing with you not only the latest trends and regulation changes, but more importantly, how digital can help you manage your business better, faster, and cheaper. As we always say, changes create opportunities. Because of the social distancing measures, we can't fit the usual 1,000 people here physically. So it's forced me and my team to think, how can we make it even bigger? And I'm very proud to say, this year, in the midst of pandemic, is actually the largest turnout ever in 18th running. As Tony has pointed out, this year our theme is digitizing corporate governance. Just like how we digitize this event, we hope you start to think about how digital tools can help you, corporate governance professionals, manage your company in a much more effective way. So in 2020, Tricor has developed a series of new innovative tools just to do that. The first one being Spot. Spot is an e-meeting solution that we're using now to live stream the event all across the world. Where you have access to internet, you can see us online. It transforms traditional AGMs, EGMs, digitally, not only by allowing members to view online, but more importantly, shareholders can now vote anywhere, anytime they have access to the internet. The second one, Portfolio. A year ago, on this stage, I've showed you a demo video of how a board portal will look like. And today, Tricor is very proud to have invested in a company called Praxonomy and brought out a product called Portfolio. We were just chatting with one of our guests. Emails now are subject to hacking. Cybersecurity is a hot topic, and with the portal, not only can you have access to information more easily, but more importantly, securely. An e-rental platform called e-rental portal. What does it do? Very simple. It helps you manage your tax more efficiently. Okay? As the tax scheme in Hong Kong called rental reimbursement scheme, we digitalize it. An issuer portal that is built with you in mind as a listed issuer. In there, you'll find solutions and services and information that's relevant to you, including the register of members, and in the near future, shareholder analytics. And lastly, an enhanced IPO app, utilizing DDA technology that simplifies the IPO application process, and more importantly, the process and payment. Now, we're not stopping there. In the coming months, we'll continue to build on our momentum and roll out more digital solutions. You can see there a human resources management tool. It's a mobile-enabled solution for you to take your leave, to apply for a sick day off. It's all digital. And of course, under the Tricor Group, we're also developing a corporate services portal for you as our clients, where you can access information and transact with us online. Apart from product innovation, I would also like to share with you some of our highlights in the past year. Again, last year, I've introduced to you Mr. Michael Xu, who heads up my trust business. It has been a tremendous year, and this year, he has signed an exclusive partnership with a leading brokerage house in Hong Kong called Everbright Sun Hong Kai. Not only that, he has also secured a partnership with Futu, which Chen Zong will also be a speaker later this afternoon. Now, enough of our business. We don't only focus on making an economic decision. In the past year, we've donated tens of thousands of masks, medical masks, to those in need. And not only in Hong Kong, we donate masks to the Cayman Islands, to Barbados, wherever we can help. We've also partnered with a recycling company called Mill Mill. We recycle every single sheet of our A4 papers into toilet papers, circular economy. And of course, one of our key objectives for the coming years is to create shared values, not only for us, our customers, our partners, with a vision to make the world a better place to live in. Now, lastly, I will not hold you any longer. Thank you again for your support by being here, and I hope you all have an enjoyable afternoon. Together, we globalize Asia. Thank you. Thank you.
Mr. Wan, may I invite you to please stay on the stage, please, because it's time for us to take a picture with you and our speakers today. Would the following please come onto the stage for the photo taking, please? Mr. Leonard Yong, Group CEO, Tricor Group. Dr. David Chung, ITB Undersecretary, Hong Kong SAR Government. Professor Casey Chen, Non-Executive Director, Tricor Group. Mr. Lucas Petrikas, Managing Director and Co-Head, Hong Kong Exchange Innovation Lab. Mr. Paul Sin, Partner, Deloitte. Mr. Catherine Wong, Managing Director, Head of Share Registry and Insurer Services, Tricor Hong Kong. Mr. Benson Ng, Partner, Ernst & Young. Mr. Benjamin Quinlan, Chairman, FinTech Association of Hong Kong. Dr. Eva Chan, Chairman, Hong Kong Investor Relations Association. Mr. Michael Shi, Managing Director, Tricor Trust. Mr. Alan Sui, Manager, Tricor Hong Kong. Mr. Christopher Louis, Manager, Tricor Hong Kong. And Ms. Rainbow Chang, Manager, Tricor Hong Kong. And Mr. Arthur Chen, Futu Securities International Hong Kong Limited. Okay, ladies and gentlemen, let's take a picture, please. May I invite all speakers, please stay on the stage. Now may I extend my invitation to all Tricor management team members to please come on up to the stage for a group photo. Please ready for a photo. Thank you very much, and may I please invite speakers, please return to your seats, except for Dr. David Chung. As we're recovering steadily from the pandemic situation crisis here in Hong Kong, our first keynote speaker, Dr. David Chung, will be sharing with us today the role of innovation in time of crisis. Dr. Chung, please.
Joe, Professor Chan, distinguished guests, ladies and gentlemen, let me once again congratulations for Tricor for great 20 years and many years to come. Thanks for Joe's invitation for me to speak at this annual event, and very happy to see many experts and friends from the industry to share their views on the latest fintech development and how digitization in corporate governance plays an important role to sustain business growth. According to the recent study by the Microsoft and IDC, almost 70% of Hong Kong organizations that were spurred by the COVID-19 pandemic would accelerate growth in digitizations. Around 55% of business decision makers in Hong Kong say that innovation is now a must for effective response to market challenges and opportunities, and to ensure business resilience as they recover from the COVID fallout. Hong Kong, as an international financial center, has highly developed ICT infrastructure, which is an ideal place to foster fintech industry development. The booming fintech industry will strengthen Hong Kong's leading edge in the financial service industry. At present, there are more than 600 fintech companies and startups in Hong Kong, with business covering payment, wealth tech, insurtech, credit tech, regtech, cybersecurity, and of course, blockchain. The fintech industry in Hong Kong has developed rapidly, and the acceptance and adoption of the financial technology by the society has increased significantly in the recent years. According to the Global FinTech Adoption Rate Index 2019, published by Ernst & Young, the fintech adoption rate of Hong Kong consumers jumped from about 32% in 2017 to 67% in 2019, which is more than double and higher than other major markets in the world. The outbreak of the COVID-19 accelerated incumbent financial institutions to embrace fintech and provides a window of opportunities for us to promote wider fintech adoption. Example, the FPS, e-wallet, virtual banks, and virtual insurers. During the pandemic crisis, the Hong Kong SAR government launched the DBIS program with about 1.5 billion Hong Kong dollar to support enterprises to continue to operate and provide services using digital solutions under this new norm. The DBIS program received overwhelming response, a total of over 38,000 applications from over 32,000 companies with 90% acceptance rate, of which about 95% were from SMEs. In addition, the SAR government established the FinTech Fast Talent Program to create new financial technology job opportunities. The goal is to create over 1,000 new job opportunities. Since the beginning of the program started, there have been about 400 applications, of which more than 110 have complete preliminary approval for new positions, and some companies have successfully hired new employees. This is a long-term strategy to expand the local fintech talent pool for Hong Kong. The fintech and regtech can become a new career path for our new generations, tapping into a growing trend of digitization and streamlining corporate governance. We also have technology voucher to help SME companies to use technology to improve business operations and enhance their competitiveness. We will soon to announce the Hong Kong Smart City Blueprint 2.0 this year to further promote the development of smart city. In the coming years, we will continue to strengthen existing work and introduce new financial technology measures, including conducting research on financial technology topics and to explore development opportunities in the financial technology industry. To further expand the applications of technology infrastructure such as IM Smart Platform and faster payment systems in financial service, we believe that advanced and comprehensive eKYC platform can promote the overall development of Hong Kong financial service industry and enhance its competitiveness. And as also announced recently, the HKMA is exploring new data strategy and considering building the commercial data interchange a new financial infrastructure to enable more efficient financial intermediate in the banking sector and enhance financial inclusion in Hong Kong. Recognizing the growing importance of the RegTech and the benefit it can offer to the financial institution, the authority has also developed a 2-year roadmap to further promote RegTech adoptions in Hong Kong banking sector. It aims at fostering more diverse and interactive RegTech ecosystem in Hong Kong. And next Monday, the government will soon to launch the mobile app, Live Home Safe, to provide members of the public with the digital tools to record their visit to different venues through scanning venue QR code posted at the venue entrance. This increased vigilance and self-protection of users, as well as their confidence in visiting different venues. The app user will participate in complete anonymity. Information of the venue that he or she visited will only store it in his own phone, and the visit records will be removed automatically after 31 days. I encourage all of you to download this app to keep you safe. Finally, I hope this year, under the time of crisis, can serve a good beginning for Hong Kong in technological advancement and grasp the opportunity brought by financial technology. Thank you all for listening.
John, may I please invite you to remain on the stage, please? Thank you very much for your insightful and visionary sharing. At this point, I would like to invite our group CEO for Tricor Group, Mr. Leonard Yong, to come up here and please take a picture with Dr. Cheung on the stage, please. Thank you, Mr. Yong, and thank you again, Dr. Cheung. Now, for those of you who dial in online from the internet, please ensure you have your speaker on the device that you're watching the seminar with turned on in order to get the audio. Our next keynote speaker, Professor Casey Chen, Non-Executive Director of Tricor, will be presented with us the financial inclusion of the digital age. Ladies and gentlemen, please join me in welcoming Professor Casey Chen.
Well, thank you. Thank you, Leonard. Thank you, Joe, for organizing this wonderful event and having me here to share my thought with you. Now, I'm going to talk about digital finance. But I know this is a big topic because a lot of people are interested in the fintech, various types of fintech, and many fintech advocates would talk about the great future where we go to, where we have a world with digital assets and so on and so forth. But I'm a very practical guy. I'm trying to think about how digital finance can really help our business. And I want to really share some of my thought along this because not all of you are in finance. You may be in different areas. But how do you think about digitization and how can that transform your business? So I use finance as an example because that's really only thing I know. If allow me to sort of like backstep a few steps, to describe how finance has been. Now, of course, finance has always been digital for a long time because even in 10 years ago, 20 years ago, when people are doing banking and doing stock investing and trading, you are basically doing it, many of you do it on the web. Not everyone doing it on the web, but a lot of people are doing it on the web. So the web-based banking, web-based trading, and web-based investing has been with us for some time. So it's not so how can we describe the latest advance in digitization and how that changed the finance area or your customer expectations? I think the big advance in the digital finance has been of course, the acceleration of the communication speed, and then the mobile phone, so people can carry in a pocket. So suddenly, with a high-speed internet, and mobile phones, people have now a device in the pocket, and they can always look at the banking. They do banking. They can do payment. They can take the phone anywhere at any time. So they have a bank in the pocket anywhere, anytime. I think that is a really fundamental transformation of finance. So with that kind of technology, very soon you see that payment has changed. People now, instead of people, you see a development of digital wallets. Digital wallet, to some extent, replace cash, but more importantly, it allows people to pay, either to the merchants or pay their friends, P2P, in a very easy way. So digital wallet happened because of internet, or the high-speed internet and the mobile device. And also, it changed the customer experience. Once you're carrying a phone, you basically make payment with your phone. You keep track of, you see how much you're spending. Okay? And then the phone will also give you a lot of potential information about the exchange rate, the stock price, and so on. So your financial life becomes very much tied to what's happening hour by hour, minute by minute, and then through some electronic device called a mobile phone or something like that. And that is really the digital finance, I think, is really coming to a new age. Because now, customers can easily, look at how much you spend during a month instead of waiting for the monthly statement from the bank. The customer can keep track of all the kind of special deals on their credit card or various promotion, and then look at the saving deposit rates from different banks, and then easily make switches using the mobile phone. So the customer's experience with finance become much more instant and interactive, and therefore we need to be more intelligent in providing those services. So I think the question is, how do we improve the customer experience in this financial journey? I think that is a key to all the finance practitioners, including the banks, the fund industry, the brokerage, the insurance industry. How do you improve the customer experience? I think that is really the crux of the matter, and that means that we really want to help the customers manage the finance journeys better. And that is what I really mean by financial inclusion. Financial inclusion doesn't really mean that you don't have people having access to a bank accounts or not, because everyone has bank accounts, at least in Hong Kong, and in most of the developed countries. But financial inclusion is still a problem because a lot of people, even though they have a bank accounts, they really don't have a lot of access to financial services in an easy way. And I think that is how we should think about, how the financial industry should think about improving the customer experience. Customers now have a tool to manage the finance. They have all the information. On the other hand, potentially they have all the information, but the fact of the matter is that they may not have all the information. This is where we come in. If you think about the whole internet revolution, before we know Google, okay, every person will have a hard time trying to look for information. You go to various places to look for information. But now with Google, with that kind of intelligent search on a platform, by typing one word, you have the information, mostly accurate information. So basically, the way I see finance, the future of finance, is where the customers can easily find information and relevant information to help them manage their finance. I think that is where the financial industry comes in. We need to, number one, what do they need? I think we need to find tools to help customers manage their expenses, manage their spending better. More importantly, we want to help the customers save money and invest money. And I'm a chairman of a virtual bank called Relab Bank. And over the last year or two, and we are developing the ideal virtual bank, we talked to a lot of people in Hong Kong, mostly youngish people, the 20, 30 years old people. And we try to figure out what is their experience with the banking industry or finance industry in generally, and what are really the biggest needs. Basically, I think that a lot of customers in Hong Kong feel that, yes, they have the banking facility, but they don't understand. They don't understand banking. They don't understand finance. They don't know how to invest. When they have some savings, some money, they don't know where to put the money in. Oftentimes these people do not have the kind of professional knowledge about investing, and they will find it difficult or to even put the money to investment. Nor do they feel that the banks they know really providing them the professional service. So I think this is the crux of the matter, because customers now potentially have the information, have the desire to manage the spending, to save, and to invest. So what is the finance industry response to the customer needs? I think that means that we really have to think about the customer's angle, try to develop tools to help the customers manage their finance better. And more importantly, I think is bridge the gap, the information gap in financial investment. I think that is really one of the most important areas where we can improve financial inclusion. This is what the customer is telling us. Now, what does that mean for the industry? Does that mean that there will be new forms of financial industry coming up, such as we'll have a mortgage Amazon or a funds products Amazon coming in, so that they're providing all this kind of financial products like in Amazon fashion to compete with traditional industry? It may, but it may not. It may not, because financial industry is highly unique, highly regulated, highly unique. I think it also means that the financial industry, from the banks to the fund management house to the insurance industry, will have to really go to the customers and see what the gaps are, and then I think by providing an information cheaper, more readily to the customers, and allowing them to make that kind of decisions on their phones, anytime, anywhere, I think that is really the most biggest improvement we can make to improve the customer experience. So it's highly doable, and I think it's highly profitable business to be in if you can satisfy the customer's needs. And I believe that same lesson can be applied to various industries by analyzing how digital transformation really changed the interface between the customers and you, and then how the digitalization really changed the amount of information the customers possess, and think about how you can actually make their journeys, make your service and products more relevant. So I think that would be my words of advice. So thank you very much for having me.
Thank you very much, Professor Chen. Please stay on the stage, please, and thank you very much for your mind-provoking sharing on financial inclusion. At this point, I'd like to invite Mr. Joanne, our CEO of Tricor Hong Kong, to present souvenirs to Professor Chen, please. Thank you, Mr. Wen, and thank you, Professor Chen. Now, the next group of presenters will be sharing with us on how new fintech solution could create new efficiencies for the entire value chain of capital market. So, at this stage, may I invite the following speakers to please make your way to the stage. Mr. Lucas Petrikis, Managing Director, Co-Head of Hong Kong Exchange Innovation Lab. Ms. Lin Shi, Chief Development Officer, Hong Kong Bit Exchange. Mr. Paul Sin, Partner, Deloitte. And Ms. Catherine Wong, Managing Director, Head of Shared Registry and Insure Services, Tricor Hong Kong. And the topic of the discussion will be how fintech will shape the future capital market. Speakers, please.
Welcome again in joining our annual Tricor seminar. My name is Catherine Wong, the head of Share Registry and Issue Services in Tricor. With us today is a group of panelists who are all star speakers in town and with extensive experience in leading fintech, innovation, capital market development, and regulations, and also industry practitioner. And with such a good panel today, what we would dive in is how fintech will shape the future capital market. I will begin by introducing Lucas on my right-hand side, the head of Innovation and Data Lab of Exchange. Lucas is the key man of innovations indeed within Exchange, in charge of modernizing the Exchange platforms, processes, capabilities through AI, smart automation, and knowledge-based tools applied across the IPO market, trading, settlement, regulations. And Lucas is involved in a lot of projects, including some of the landmark reforms of the city's IPO regime. And also in our panel is Lin Shi, the Chief Development Officer at Hong Kong BitX. Lin has extensive experience in capital market, starting in US and later moved to Hong Kong, and have a wide spectrum of experiences in covering M&A, IPO, private placement on deals from various markets. Many of us actually know Lin have moved to Exchange in 2013 and was the head of IPO development who looked after the IPO application for listing in Hong Kong. And on my left-hand side is Paul Sin, partner in Deloitte. Paul is leading the fintech practice and Asia Pacific Blockchain Lab in Deloitte. And Paul has been a practitioner in the market for a long time, working and focusing in financial services sector. So a quick panel here and most qualified to give us some insight on our topic today. So I'll start with Lin first. Now, Lin, we have been seeing a lot of latest trend and innovations in the capital market. In these 1 or 2 years, we've seen some direct public offering like Spotify, and some other approach in the IPO market, instead of using some traditional book building process, and also some alternative exchange has been established, like the one that you're working on. Do you see that's a sign that the existing IPO market would be somewhat disrupted? And do you think that there will be new business model that you expect would evolve with the new technology being available?
Sure. First of all, thank you very much for inviting me here. This is a great panel to speak at. I think it's a very interesting question. Certainly, there is always room for improvement. And we all have to evolve as the market is changing. And what I want to point out is with this digitization and with the virtual exchange that my company is building, it's really more than just IPOs. It's really more than just shares and bonds, which we're familiar with. We're talking about opening up a new asset class, which if you can own it, you can trade it on this exchange. So certainly, I think that we're going to be revolutionizing the capital markets because we're going to be able to democratize a lot of capital raising. Early stage companies which had to rely on just their own networks or perhaps venture networks will now have a greater access. Certain types of ownership interests which could not be traded because they were quite difficult, such as private equity interests, can now be tokenized and traded. Other type of what we would think as more commodities, either, for example, fine wine, art, that can all be transformed into tokens. So absolutely, I think not only will the IPO market be disrupted, but I think just capital fundraising in general will be disrupted.
Right. We were talking about other, digital assets and things like that. Do you see that, there are comparative benefits for these digital assets actually compared to the traditional model of our existing IPO market? Do you see that there would be lower cost or higher transparency, or what sort of active benefit do you think that it would bring to us?
No, I mean, absolutely. I think a lot of people focus right now on just settlements, right? It can have instantaneous settlement because you've got everything located on the token. And obviously, you guys are talking about corporate governance. And there's a lot of transparency and efficiency with the blockchain technology that can bring into corporate governance. In addition to what you were highlighting earlier regarding AGMs, EGMs, and voting, it's also knowing who your shareholders are, right? Knowing who your security holders are. Because right now you have to go to the nominees and you don't actually know. And it takes time to figure out who the person of record is if you're making distributions. All of that can be efficient, more efficient. But it's also, if you think about higher up on the value chain, if you're a company with a long payment process, once you have that information stored in the blockchain, you can get it real time. Or if you're, say, you have certain ESG standards that you want to abide by. If you're a company that says, I want to make sure that my contractors don't have child labor, or that they use a certain type of material, how can I have confidence that what they're telling me is true without personally sending someone there and checking every step of the process? Again, that is something we now have the technological solution for. And so that's the kind of revolution we see, efficiency, transparency, that will bring more confidence to investors.
Sure. That actually sounds very interesting. Maybe I will switch to Lucas now. We know that exchange being the core market infrastructure. Indeed, there are a lot of initiatives that has been introduced by exchange, including study on applying blockchain on Stock Connect, and also shortening of the IPO settlement cycle to modernize the existing capital market. Now, referencing what Lin just said, there's a lot of technology, tokenized asset, or more aligned with the blockchain concept. Do you think that sort of concept would soon be adopted within exchange, and in what area do you think that would be?
Yeah, this is a great debate. If I can condense 5 years worth of blockchain, hands-on experience into 1 or 2 sentences for the exchange, I would say we see it as a contender. When you need to synchronize workflows and data sharing across a large group of players, we see blockchain as becoming increasingly viable contender and a competitive technology to do something that can be done on traditional centralized technology and to do it just as well. Now, I think the question that people ask is, what is the thing that makes blockchain the better solution than centralized technology? And with that, my answer is it depends on how much trust is missing in your system. If you have a need to exchange information across a domain that has very, very high walls between people, and they don't trust each other. I think share registry is a great example of that business where your shareholders might be all over the world, and whether something is recorded the same way in this part of the world or that part of the world, maybe you're not quite sure whether it's true or accurate. Maybe that could be a place where the mechanism works well. On the other hand, you have markets that have fairly low walls between people's gardens, and there's a high degree of trust. And those tend to be markets that have a history of being regulated by a central operator or a regulator, and have a way for you to hold each other accountable in a court of law, or effectively a system where you have a way to hold each other accountable through the legal framework. Then the benefits of DLT, I would say, are probably less obvious. The distinction between taking a node in a network and communicating through a ledger API with a node that's on someone else's data center, I think is widely misunderstood. That distinction from the perspective of the user makes almost no difference. It's whether you find something more interesting to do with the information that's on that node. And in that sense, I would say the part about blockchain that excites us most is not the infrastructure layer, is not the fact that you have 50 nodes instead of 1. It's the language of the asset, what people call the smart contract, the smart contract or the scripting language, because that lets you reimagine how you use information. Instead of conceptualizing finance as basically a set of account-based structures where account A has 100 shares, account B has 200, you can basically imbibe the asset itself with a self-sovereign identity and asset code that even if you don't use blockchain, if you use a centralized layer, lets you exchange information better. So in that sense, I wouldn't be surprised if the next phase of blockchain is solutions that are inspired by blockchain but don't actually use blockchain, like China's central bank digital currency. The other thing I would say is, just to respond to a few things Lin raised, I think there are I come across 3 sort of popular myths about blockchain and capital markets. One is that tokenizing something will make it liquid. I think being an interesting asset is what makes you liquid. We have 2,530 companies listed in Hong Kong as of this morning. Of those companies, I mean, the typical cutoff for an institutional investor is if there's $1 million US a day of liquidity, people tend to get in and start looking at the order book. How many of those 2,500 stocks do you think have $1 million US a day of liquidity? Probably 300, maybe 350, maybe 1 in 7, right? So actually, being listed even on the most sort of efficient central order book doesn't necessarily make you liquid. Cutting something into smaller pieces doesn't necessarily make you more interesting, but of course, for certain assets, that will help. Number 2 is that effectively storing something on a blockchain makes it more true. I think Lynn was alluding to fine wine and child labor, and it's great that there is now solutions in the market where people can effectively record that information in a way that's sort of at least more standardized. But you still have the information in the blockchain is about as honest as the actor who entered it into there. And if I come and drink your very nice wine, your blockchain will be none the wiser as to that happened unless you have a sort of physical element to that solution. And the final thing I would say is sort of myth number 3. This is my favorite one. It's probably the least understood. Is that there's this belief that accelerating settlement finality and transacting things, you can trade things in microseconds now. If you can settle it straight away, wouldn't that be great? That would take us forward. I think that actually takes us backward. That takes finance backward 600 years to, the medieval Renaissance fairs where the concept of clearing was invented, that you sort of go to the market and exchange IOUs for pots and pans all week. And at the end of the week, you go there, there's a table, you put your IOUs on the table, and hence the word clearing, you clear the table until you netted everything, and your UOMEs and IOUs are exchanged. Today in markets, in most markets like Hong Kong, we have a netting efficiency of about 90%. That means for every $100 you trade, you only move $10 at the end of the day. If you made everybody move the 100 in real time, it would reduce the volume by 90%. So actually, in many ways, I think Greenwich Associates called this DLT maximalism, where now there's actually, by pursuing this to its logical conclusion, you're actually taking the markets back in time from being a credit system to being a payment system.
Yep. I think that you actually made a lot of valid arguments and discussions around the blockchain areas and how and what case that will be adopted. I think blockchain, in a way, there's a lot of debate about whether the peer-to-peer is actually providing a more efficient way of doing things, or is that centralized platform, as you mentioned. I think both ways, as you mentioned, they probably prove its own efficiency, its own remake in different situations. So you did actually mention about clearing, that we know that netting is giving us a lot of efficiency and cost today. So I think that's still actually, it sounds like the debate is still going on. It seems that the tools are useful, but where and when we should actually apply that probably is the critical area of discussions. So Paul, we know that there's a lot of that you have been the practitioner that actually seeing a lot of people adopting different fintech tools. Particularly about blockchain. We've seen ASX, Australian Stock Exchange, actually using it as a tool to replace its post-trade systems. What is your view on the market challenges in adopting blockchain, and what's your personal view of how efficient or benefit that you can bring?
Thanks, Catherine. So I think, first of all, blockchain is probably one term which is highly abused because everyone uses blockchain to represent very different things. So, we just heard Lynn and Lucas talk about 2 different kinds of blockchain, which is quite different. So in a crypto exchange, we use public blockchain, and a lot of times a user can stay anonymous, and we can tokenize a lot of stuff without going through a lot of regulations and all that. But then for stock exchange, a lot of times you are not using public blockchain. We are using permission blockchain.
Yes.
That's why when Lynn talked about all the asset class that can be tokenized, this is more focused on tokenizing, creating a digital representation of those assets. Whereas when Lucas talked about the application, it's about creating something that can even be replaced with a centralized database. so all the stakeholders in the ecosystem can exchange data, can synchronize data in a named user basis. So that is very different. And when we talk about challenge in adopting this technology, these two kinds of blockchain were very different challenge. Like if the users are anonymous, then the concern will be more on the KYC, on the money laundering, etc., or illegal fundraising and all that. When we are talking about enterprise application, permission blockchain, people are named users, then we are looking at the governance model, like what we call KYM process, know your member process, who can join the network, who can digitally endorse a transaction, who can submit data that can be trustworthy. As Lucas just mentioned, the data is as trustworthy as those people who put the data in.
Yes.
So
Yes,
if you let everyone to come in anonymously put in data, then the blockchain is worthless. And there's also another issue, because permission blockchain is enterprise scale. That means people in the ecosystem are all corporates. A lot of times they are large corporates, like the stock exchange have a lot of market participants. These people will have a lot of concern in the ROI of investing in those platforms. So who is funding the platform, who is building that, who is hosting that, who runs that? And because no one wants to pay money to host the data, that's why it becomes a centralized database. So these are all valid issues which slow down the adoption of the technology, I would say. Apart from all this, there's also interoperability issue. So we are no longer 4 years ago or 5 years ago when blockchain just emerged. We already have a lot of ecosystem, a lot of exchange, a lot of crypto exchange using blockchain. How can we create interoperability between these existing platforms so that data can be exchanged without losing all the authenticity and the trustworthiness of the data? That's another challenge that we are facing nowadays.
Okay, sounds like, you know, blockchain and these new technology all are very good tools, actually can provide a lot of benefit, but at the same time, it does actually have its limitation as for now, and in different cases, as we mentioned, it does actually, there are some roles ahead that we have to look into solutions or how to conquer those challenges. So I think that, you know, there's a very, very great conversations that we have today. We're running a bit behind of time. Thanks so much to our guests for sharing your insight with us today. And that will bring us to the end of these sections. Hope everybody actually enjoyed it. Thank you.
Thank you.
Thank you.
Thank you very much. Thank you very much. May I please invite you to stay on the stage, please? Yeah, thank you very much for the mind-provoking sharing. Now, may I please invite Ms. Catherine Wong to please present souvenirs to our guest speakers, please. Thank you once again, Ms. Wong, Mr. Patrigas, Ms. Shi, and Mr. Sin. Wow, so far the presentations has been very informative, and we have certainly learned a lot, I myself, and have explored my knowledge level to a new frontier, and I hope you all do enjoy it too. And just wanted to check with our dial-in or virtual participants. It was a bit of an obsolete term, dial-in, but all the virtual participants to ensure everything's going okay at your locations and you're continually enjoying the seminar for this afternoon. Our next speaker for the presentation, Mr. Benson Ng, partner at Ernst & Young, and he is going to share with us very, very important knowledge on the digital corporate governance from internal to external. As we're preparing for our stage, If I may invite Mr. Benson Ng, partner in Ernst & Young, please come on up to the stage, please. Thank you.
Hello. So thank you for Joe and also all the Alliance colleagues from Tricor to invite me to share my thought about digital corporate governance today. It is the worst time, the best time, the time of despair and also time for innovation. It's Tricor's 20, right, and also on 2020. And if you did on Wednesday, go on the Double 11 to do your e-commerce shoppings, right? It is a very interesting time. And also today, I think is a happy Black Friday, but it's 13 in Chinese is also a very lucky number. So it's a time mixed with all the positive and the negative things. Today, what I want to share with you is in such a disruptive time, what are the key capabilities for corporation to be able to stay on top of all the trends and the risks from internally and also externally. And myself, I lead EY's business consulting practice for Hong Kong market. We are about a 500-ish people team, and we help our client to transform their business through the power of people, technology, and innovation in many of the areas, like in the customer experience, in supply chain, finance, and of course, corporate governance and risk as well. And we did a global board risk survey right before the pandemic get into its core in late 2019. We surveyed about 500 board executives back then. And I'm going to share with you some of those, I think, things that they share. But of course, when they answer this survey, none of them will have foreseen what is going ahead for them in the next 14 months. The first part is we found out that when we're asking the board executive how ready the organization is able to handle the atypical risk, close to 14%, only 14% of them said that they have effective capability to be able to manage on top of the atypical and the external risk from internal capability perspective. And what are those major obstacles from the organization perspective, right, that they mention the most? If you look into on my left-hand side, okay, the top things on the agenda are things like talent and skill set. And when you look into the pandemic time ahead, when they're answering that, right, then they will see that, in fact, they don't have the talent and skill set on how to manage communication better. And then the second part is about how they can see disruptive factors long and far enough. And also about do they have a good enough risk insights, both high quality and also predictive, that they can forecast how things may move ahead. And the other factors are extremely important is also coherent to what Tricor's theme this year is about the digital and the technologies. And many of these board executives roughly knew that these are the major blockers for them to stay at top of the pandemic time. But none of them will have really experienced how important these are really. And then we're also asking them, right, from the interactions with their management team, both from the management, are they getting the type of the risk insight and the report good enough from the management team? It's only half of the surveyed participants said that they have received enough risk insight from the management team. And on the other hand, if you look at the ring, right, so who bear the fault for not receiving the right type of the risk reporting, it's also only 50% of the board said that they have clearly communicated to the management team what they need. So the communication, even before the pandemic time, is not very smooth. It's very difficult and not always accurate, and not on the point on what they're expecting. And when pandemic came, right, a lot of the general meeting and also the board meeting was postponed because of the fear of the pandemic issues. But is it the right thing to do, right? In fact, in the pandemic durations, we need more communication than the normal time. One thing that we found is some of the more progressive regime and the countries, for example, like the Finnish, right, in April this year, they start to push a temporary regulatory reform to change their regulation that allow AGM be conducted remotely through digitization and technology. So some of the countries around the world, when they see the corporate governance was impaired by communication breakdown, they will really take proactive measures to encourage the society to think differently using disruptive technology. And then we also asking the board on what about the external communication part, right? Other than you communicate with your management team and also your other board of directors. There's also a lot of the feedback coming back that they think it's critical for the board to also maintain frequent and good communications with the external parties. And this includes, for example, like subject matter expert on managing pandemic or subject matter expert on digitization. And this also includes maintaining frequent and good communication with analysts to ensure that they understand what will pandemic means to their corporate performance. And how do industry analysts be able to give them a fair assessment on what will be lying ahead for their recovery path from a performance perspective. So external communications is also increasing by a significant amount during the pandemic and what we will be anticipating for the next 12 to 16 months. And of course, you will also see in here the ability to be able to communicate with their peer directors, right? Many of you may have served as multiple companies non-exec directors, right? Are also very, very important as well. And the type of the communication advice that you can get from the external, one thing is about the current situation. The other thing is really for the board to be able to look beyond just the near and medium term, but about the long-term prospect of the society and also the corporate landscape on what is going to change what we call the 3 stage, the now, next, and beyond, and stay on top of the mega trend. And for example, some of those mega trends have very tangible interaction and impact on the post-pandemic recovery world. I give you one example. You see this terminology in here called the behavioral economics. Behavioral economics means now the society and the corporation have the technique to use a digital marketing to encourage you and also to shape you to behave in a certain way. And this is particularly important if you look into the pandemic impact on US, on European. There are many things that can be accomplished if the society or the government leverage behavioral economics that can encourage people to wear masks. That can also encourage people to do the right type of the things to be able to recover better. And another mega trend that you saw in here, a lot in the yellow, is about the synthetic media. This is a very new term, okay? So those of you who are into artificial intelligence, you may have heard about a new acronym, okay? It's called the GPT-3, okay? But what GPT-3 really it is a machine learning model that some of the best funded technology organizations used close to $4 million to develop and train. The GPT-3 AI model now have the ability to generate news and article that normal human being will not be able to distinguish whether it is right by human or right by the machine. So think about it. How many of those news that you read from all those news websites do you still think it is really authentic, right by news reporter? What about organizations who use such GPT-3 technology to generate massive amount of rumors? How do corporate be able to stay on top of such a landscape, right? When a negative press or news can be fake, can be massively produced to the quality that even investors will not be able to discern. So a lot of this mega trend in the next stage, beyond the now, is very relevant for the board. Because when you say next, it's actually just 2 years from now. By the time you develop a strategy to respond to that, to improve your corporate governance, you're already into the hardcore of this type of the crisis. And also a lot of the other mega trends that you may have heard and seen a lot as well, right? For example, the work and also the life unbounded, right? What does that mean, right? There's a joke said that only when the tide goes out, we know who is swimming in lake, right? Okay. And I saw in many cases, only when the people mistakenly open the camera, we knew that they are wearing in pajamas attending the Microsoft team meetings, right? So when the work and also your life mix together, right, it's really a different way of the working lifestyle and the way that you need to treat your employee, your business partner, and also the investor as well. So it's important for the board to do good communication, external communication frequent and enough to get the advice and then to be able to develop strategy to mitigate those risks caused by the megatrend. And in the longer term, the board should be focused on doing just one thing. What it is, right, that we learned from the pandemic is about the terminology called resilience, okay? So now, more than ever, all the boards around the world are thinking about how can they build a more resilient enterprise. And there are 9 different aspects or character to be able to do that. And I won't mention all of them. I would just want to highlight 2. The first is about the human being aspect, right? How do you develop capability that you can handle your employees' well-being, your investor, your non-executive director's well-being, right? Okay, using good technologies to be able to work with them closely. The human aspect. And of course, your customer as well. And the second aspect that I want to highlight in here is about the supply chain. The world is so complex now, the trade war and all the other things, right? Supply chain resilience is much more important than a lot of the other factors. And this doesn't apply just to brick and mortar type of the organization. Even for bank, for services industries, if you think about all those technology that you acquire from around the world, you face the same risk as well. So that is a long-term goal that board should be focusing on. And in the near term, for the now and next, right, I think to closing up what I want to share, they say that you need to reiterate important things 3 times, right? It's really about communication, communication, communication to improve the corporate governance. So the board, we need to acquire the capability now to be able to communicate regularly with their investor. And also acquire the capability to meet not less because of the pandemic, but more because you are facing more risk, either virtually or in a hybrid fashion. And the last is to communicate good quality of the insights that you take from the external advice, and also predictive enough to see in the future as well. So I think that's what comes out from what we learned from the last global board risk survey before the pandemic. And now we are in the middle of it, looking back on what it really means. It's all about communication, communication, communication. And to do that, technology have a big play in here. I think I would urge all of you, because of this time, it's a disruptive time. It takes a disruptive capability. Let's put technology to work. More budget for your technology team, and then let's get back to better, right? Not just get back to normal. Just like Tricor's event today, probably is one of your highest attended events in the last several years because of the digitization. And that's what I want to share. I hope you can do good through better communication. Thank you.
Thank you very much for very inspiring and very visionary sharing, Mr. Ng. Now, please remain on the stage, please. And now I'd like to, thank you, Ms. Jennifer Ng, our Executive Director, Commercial Services, Tricor Hong Kong. Please come on up to the stage and present souvenirs to Mr. Ng. Thank you, Ms. Ng. Thank you again, Mr. Ng. Thank you. Now, our next presentation is going to be hosted by Mr. Benjamin Quinlan. Benjamin is the chairman of the FinTech Association of Hong Kong, as well as the CEO and managing partner of Quinlan Associates. Please join me to welcome Mr. Quinlan onto the stage, please. And he is going to be sharing with us on digitizing corporate governance in a COVID-19 age.
Good afternoon, everyone. It's a pleasure to be here, and it's fantastic to be back at a physical event. As was heard before, the only downfall is I had to get out of my pajamas and put some pants on, but it's nice to be back presenting to a live audience room. Today, I'm going to be presenting about digitalizing corporate governance in the COVID-19 age. And I think we can all agree that 2020 has been a year of great change for many of us within our businesses. I'm going to start off by looking directly at the topic of regulation and how that is evolving. This first slide is really just to give a bit more context around the fact that regulations regarding corporate governance and transparency are on the rise worldwide. It does not matter where you're located. For example, if you look within Singapore, disclosure of ESG requirements or integrating them into your reporting is now needed. When you look at Norway, 40% of your board needs to be composed of females. When you look at the UK, we all understand the GDPR regulation has had a whole different layer to the kind of data privacy and protection that is demanded of many companies around the world. And the overall narrative is that corporate governance and transparency requirements are on the rise. Now, if you look at the problem statement, a lot of people, if I ask you how many board members are there in this world, many people don't know. So we tried to have a crack at this ourselves in my company. And we broke down the industry in terms of how many listed companies, how many unlisted companies there are, how many NGOs, the size of the companies, the average number of board members, actually if they have a board in the first place, and the average number. And we actually calculated through to about 36 million board members worldwide. We expect on the back of all these new regulatory standards that number is due to rise to about 58 million by 2024. So there is definitely growth in this space. However, companies are instituting boards, they're instituting their processes, but many firms around the world are still plagued by corporate governance scandals. Many famous names on here. We all know the case of Enron. I would assume many people in this room do. That's one of the most famous accounting and governance fraud scandals that occurred back at the turn of the millennium. But as we fast forward, even things like Uber, right, got in trouble because of company-wide gender harassment lawsuits. We get to cases like Barclays. The CEO of Barclays at the time, Jess Stately, got in trouble for basically bypassing their whistleblowing protection mechanism. And then you've got companies like Facebook, basically unconsented access to data. And this is obviously becoming a key concern for many businesses around the world regarding data privacy and protection. So how do you get this all sorted out? It really boils down to effective corporate governance. And if you look at what makes good governance, there's really just 5 key themes. You look at it here, it's responsibility delegation, number 1. So the right roles and duties to managers being assigned to secure a balance of power across the organization. Secondly, rigorous policies. So comprehensive policies and incentives to drive compliant actions and behavior. Then you look at disclosures, frequent and regular reviews and disclosures, and external and internal examinations. And then on either side, you have what is effectively two-way communication and two-way monitoring. Now, if you address all of these 5 in their entirety, and you address them in the right way, you're on your path to developing what is effectively a good corporate governance framework. The problem is many of these things, or many of the processes around corporate governance, are very manual in nature. Now, if I look at how we can change that, it looks like a same slide, but it's not. It's effectively the whole digital transformation of corporate governance. So what can we be doing along the responsibility delegation part, rigorous policies, disclosures, communication, and monitoring to make this process more automated and more streamlined? And there's one area in particular that I want to go in today, and that's really around board processes and the management and operations of the board itself. So I'm not going to go into this one in detail. So let's touch on this one. Can I get a show of hands? Is anyone here sitting on a board? Right, as am I. If I ask you how you run your board book process, would many people here say, we organize a meeting through WhatsApp, we send our meeting minutes via Microsoft Word, via email, we then put documents into Dropbox for review? It's probably one of the most inefficient processes. Now, if you look at how boards have managed their board books over time, we've effectively seen what is 4 generations of evolution. It first started at printed documents. We then moved to email channels to be able to send those documents around. After that, creating online networks, and then ultimately to what we call Generation 4 collaboration tools. Now, along this journey, you were able to address, you see along the chart at the bottom, things like instant delivery, version control, and real-time editing. I think we've all been victim to the pains of version creep, and reviewing and seeing documents that were not the right version for us to have a look at. And that's all well and good. But there is a big problem with these 4 generations of solutions. And that's really around what you see as meeting management, right? What boards specifically need to do. And if I look at my own job, sitting on boards as well, I find it very frustrating when it comes to using these tools that aren't appropriately customized to the specific things that I need to do as a board member. Anything from meeting organization, minutes, proposal voting, documenting your decisions, committee channels, archiving, task management, as well as document organization and reliable security. And I can't stress the importance of reliable security. And I think a lot of people have been looking and realizing that many of the tools out there are prone to hacks and attacks from a cyber perspective. Interesting little fact as well. We estimated that about $5 billion annually is spent on printing, processing, and shipping paper-based board packs. And I've often been in meetings with my clients, and they will put a Bible's worth of paper on the desk of every single person there, and I just can't help but think of the sheer amount of waste that's happening in this regard. $5 billion per year. That's a lot of money thrown down the drain. So we've seen what we call Generation 5 of the wave of digitalizing corporate governance. And these are the new solutions out there that we call board portals. Some of you might be familiar with them, others who aren't, that's all right. But this Generation 5 board portal solutioning is really all about things like data security, regulatory compliance, board efficiency. It's the whole digital transformation drive to create customized workflow solution and collaboration tools that are very much tailored to what boards of directors need to do. And there's some companies here on the right. You maybe see some names. Some of these you may use. But it's a relatively nascent industry. It's not so new, but it has been around a while. So there are some established players within the market. Now, if I move on to this, the whole market sizing that I did before, that 36 million board members, what does this mean for how much money people are currently spending and can potentially spend on these board portal solutions? So you see here, there's a lot of views around, we calculated the number of board members across the world. We add on people like board administrators, company secretaries, other people that may want to plug into these solutions with the companies. And we have to understand the penetration rates. If you see in the blue boxes, portal penetration, these are highest probably with larger listed companies. As you move down the client curve, the penetration of these solutions is very low, particularly in Asia. And many of the companies that do use them are either based in the United States or Europe, because many of the firms that offered them originated in the US. But going forward, if you look at 2024, I think it is a very rational and reasonable assumption to say that 95%, if not 100%, for example, of listed companies should be using some form of this solution and no longer relying on WhatsApp or Word or email or other things to conduct their board meetings, especially for a listed company. And if these kind of assumptions hold true, you're going to see a board portal market basically exploding from about just over $1 billion in 2018 to almost $11 billion by 2024. I think the point that was mentioned before was around the transformation of the way that people are doing meetings as well. You can see here's some data from all listed companies in the United States, and then S&P 500 companies on the right. And what you're finding is that the increase in virtual meetings, and this was for the first 4 months of the year, for all companies in the US went up about 225%. This is for listed. If you look at US shareholder meetings on the S&P 500 that moved to digital, in 2019, online, it was about 23, shot up to 87% year to date. Right? So that's a very compelling number around changes in behavior and changes in the way that boards are conducting their meetings. Now, many of you are asking, so what do board portals do? So here's an example. These are actual real case study examples. You can see some of the functionality, pre, during, and post-meeting. You can use these solutions to go on, organize your meetings, create an agenda, track what people are doing. You can live, minute, and note take with some of the solutions out there in the market. And if I look at the efficiency of board processes that don't run on these digital platforms, they're woefully inefficient. If you look at the benefits, you basically break it down into 3 key clusters. Firstly is for the board members themselves, so provides you with a personal dashboard, flexible access, digital board packs, the administrators to actually oversee and manage the board meetings much more effectively, and for collaboration as a whole. And I think collaboration, particularly in a digital environment, is extremely critical. So the whole idea is how can these solutions help boards work smarter? Here's another example of when you land on the various pages of a board portal, what do you see? Such as a board meeting page. You see a board pack viewer. You see task management, right? Highly intuitive solutions, not every single one. I've played around with a lot of these, and some of them feel and look like Facebook. Other ones are probably a bit more clunky to use. But overall, the idea is to create an online virtual environment where you conduct your board meetings in a much more efficient manner. I think what I was mentioning before around data protection, it's getting pretty obvious right now, all across the world, that you need to have the best and most stringent data protection standards. And a lot of these protocols, and this is another real example from a board portal, the emphasis on things like cybersecurity, the emphasis on things such as hardware security and data privacy. So storage, transit, server protection, even smack bang in the middle. I guess what you would call the gold standard for these solutions around security is the ISO 27001 certification. So again, huge emphasis on this in terms of being able to protect the information of the board, and I think it's absolutely critical because obviously the information that is being shared at that level of an organization is likely the most sensitive. Some of you are asking, how much does this cost? So we did a benchmarking of the various solutions out there. There's a lot more that could go on this list, but here's a snapshot of about half a dozen. Anywhere from a diligent right up the top, price per board member of about $1,200, but you also have setup and implementation fees for some of these solutions. Others don't come with them. And then you can see right down the bottom, among the cheapest and most cost-efficient solutions, something like a Praxonomy. We've done our homework on this. An average board size of about 6, you're looking at about $2,300 US per year. So why does this all matter? Why does this all matter? Because at the end of the day, it's all about driving more efficiency, better productivity, reducing time, streamlining operating costs, and potentially getting rid of all those nasty fines and penalties that companies face. Our estimates is if I look at my traditional process of managing board meetings from a paper-based process to a digital, I could reduce my time spent by about 2/3. If I look at that in terms of an operating cost, not just in terms of paper, resource printing, packaging, but also the time of the board members and the opportunity cost there, probably a 50% savings. And if you're looking at fines and penalties, again, this figure may be a bit up in the air, but the reality is, you could see from the example I presented up front, if you don't have your data privacy protection, cybersecurity, and all of that in place, and you are getting involved in the wrong kind of data governance breaches, you are going to run into some big trouble as an organization. So I think the overall narrative that I'm effectively leaving you with is the presentation today is really about understanding this next generation 5 wave in the way that boards of directors can manage their processes going forward. Okay, that's smack bang on time for me, but thank you very much for your attention. I hope you enjoyed the presentation.
Thank you very much for the very detailed and informative presentation, Mr. Quinlan. At this stage, please stay on the stage, and if I may, please invite Ms. Wendy Kam, Executive Director, Corporate Services of Tricor Hong Kong, to the stage and present souvenirs to Mr. Quinlan. Thank you, Ms. Kam, and thank you again, Mr. Quinlan. Now, before we take a break of 20 minutes from the seminar, let me introduce you to an eye-opening digital experience that we have put together for you today. We have put together a 360 corporate governance lounge out there at the foyer. At Tricor, we provide digital corporate governance services and solutions. SPOT, in short, supporting our clients that runs host meetings that requires voting. And Portfolio, briefly, that helps us, the board of directors, to run more effective meetings. And the 360 Corporate Governance Lounge out there basically is designed based on the same logic. In the outer ring, we have SPOT, followed by the Portfolio in the middle, and then wrap up with e-rental portal at the inner ring. So during the break, may I please invite you to drop by the lounge, interact with the special features, and also please share with us your digital experience via SPOT. Now, upon registration a couple hours ago, each and every one of you were given your own personal login to the SPOT. Now, if I may invite you to scan with this QR code on the screen here, log into SPOT, and share with us your experience via answering the 4 questions listed in the SPOT. And we will be looking at the results at the end of the break, and we're going to go through them together. And for those of you are dialing online, you will also be invited to experience this as well. Our live cameras will be there to assist you to experience the lounge. So, ladies and gentlemen, at this point, let's take a break from the seminar, and if I may invite you to come back to the hall here at 4:05. That's 4:05 in the afternoon, and please enjoy your break and the 360 Corporate Governance Lounge. Thank you very much. See you in 20. Welcome back from the break, ladies and gentlemen. Well, I hope you've enjoyed the break and the 360 Corporate Governance Lounge. Now, as I mentioned before the break, there are 4 questions that would help us to understand your digital experience on the setup we prepared for you today. So, well, the answers has all brought in, and we're going to be showing them on the big screen here. Now, okay, let's take a look at here. Now, the questions are not listed here, so let me just recite you the question. For number 1, as you can see here, number 1, the question was, do you get all 3 illusions, 3 illusion messages at the setup? We have a percentage ratio here, 75% to 24, which is not bad. And I heard the rumors it has to do with the fact that there are no snacks being provided today. And it could be the fact that it's too elusive. And number 2, the question was, did you take a picture of the hologram demonstrated in the lounge there? And the ratio here is 41 for and 58% against. Now, the reason behind here is a lot of the online participants were not able to capture. They were able to see it, but they were not able to capture it on a photo. On the screen, obviously. So that is the reason for that result. And for number 3, the question was, do you like our setup at the 360 Corporate Governance Lounge? And as you can see, it's the 4 ratio, 87% versus, I can't even see it, it's 12%. Okay? So thank you very much for your support. And last but not least, we have an amazing smoking 99% of you thinking you'll be back here and enjoyed our Tricor seminar next year. So to that, thank you very much, ladies and gentlemen. Thank you. Now, we're at the stage of the seminar today where we're going to go into pair speakers for the rest of the presentations. So for the next pair of speakers who are going to be coming up to the stage and share with us, there will be Dr. Eva Chen, Chairman, Hong Kong Investor Relations Association, and also Mr. Alan Sui, Manager of Tricor Hong Kong. So at this stage, may I first invite Mr. Alan Sui to come up to the stage and share with us your presentation. And the title would be ESG, the current landscape and highlights of the new Hong Kong Exchange reporting requirements. The floor is all yours, Mr. Sui.
Hello, everyone. I'll be doing my presentation first, and then after my presentation, I'll be inviting Eva Chen to the stage. She's a very seasoned professional, a lot of experience in corporate disclosure, so she'll be giving her perspective on ESG disclosures. I'm really honored to have this opportunity today to share with you on ESG, so I thank Daryl, Joe, Brenda, Cecilia, and certainly not least my GRC team. I'm Alan, manager of GRC team of Tricor Hong Kong. GRC stands for Governance, Risk, and Compliance. Our team advises clients on risk management, internal control, and of course, ESG reporting. My talk will be split into 3 sections, shown here. I'm going to spend quite a bit of time talking about current ESG landscape before I'll go to look at some of the key changes in the latest Hong Kong EX updates. Then in the final section, I will be talking to Eva. So ESG is such a broad topic, we can barely scratch the surface with this talk. Hopefully this will inspire you and give you some information to do your own research. If you have any questions, then feel free to contact me. The current ESG landscape. Okay, first, the demand of ESG. We're going to talk about that. Then, because I'm a practitioner of ESG reporting, I'm going to share my experience on the problems that I face. Then lastly, we were going to talk about why it is important that corporate should do it and how to go about doing it. Okay, let's start then. Today's theme is digital corporate governance. Similar to corporate governance, ESG is also just a way of building a trust in cooperation. So an essential element in building this trust is having good relationship. With cooperation, this relationship is with stakeholders. And with all good relationships, communication is a key. Benson from EY, he said it 6 times. So this is the transparency that we always talk about in business. In the world that we live in, we are well aware of many social current issues. For instance, within developed economies, there's wealth gap between rich and the poor. Majority of the developed economies grow richer. Underdeveloped countries, they're left behind. Also, natural rainforests are destroyed because to make way of human activities. And animals that have lived with us for thousands of years are now facing extinction. With all these challenges, once in a while you see on the news that social malpractices happens in business. And these negative publicity, coupled with the general lack of ESG disclosure, you really cannot blame the general public to think corporate is just this money-sucking monster that slowly destroyed humanity. So in the past, financial frauds from corporate bad apples, Benjamin has also mentioned Enron, WellCom. These led regulators and the public to impose scrutiny on how corporations are run and led to demand and better financial disclosure and also corporate governance disclosure too. So now with these negative publicity regarding ESG malpractices, there's also no doubt that there will be more demand for ESG disclosures, just like with financial disclosures. So the urgency is even more now than ever for you to take initiative to incorporate this ESG disclosure as part of your corporate governance transparency to help corporation to build this trust. And with digital technology, okay. And with digital technology, the demand for transparency is even more amplified, even because of the ease of communication and information availability. So what do the regulators and the public expect corporations to do with respect of these ESG disclosure? These social challenges that we talk about, increasingly people are pointing their fingers at capitalism. And although it helped drive economic efficiency for most part of the Industrial Revolution, these efficiencies are done at the expense of society. Those who acknowledge this problem will give, we'll give capitalism a little tweak, looking at alternative ways to run a corporation under this capitalist system. So new ideas has come out, such as stakeholder capitalism or corporate stewardship, that corporations should be a good citizen of the world, not just to serve the interests of the shareholders, but also other stakeholders. So we should explore these concepts in more detail later when we talk about corporate social responsibility. So with these ESG disclosure, now the demand is also not only numbers and charts, rather they are narratives related to the organization, more rather soft qualities such as culture, value, purpose, in order for them to get a clearer picture of what is really behind the scene or running of the organization. So we'll continue to see more and more demand of ESG disclosure. It is no longer nice to have. So it should be increasingly clear that it is also corporate's best interest to do so. Now, with all these demands in ESG, it is easy to find information, how wonderful it is. But of course, that's only one side of the story. So now, instead of the pretty side, I'm going to tell you all the ugly side, the problems with ESG. First, there's a problem of how to do it. We are talking about the approaches and practices. Everyone says that they're doing something regarding ESG, but ESG means many different things to many different people. Are we doing too little? And am I doing too much? Who is doing it right? No one knows. Then there's the problem of the purpose of doing it. Different people have different purposes in mind also. Some view it as a compliance exercise, just a way of burning money to please regulators. Some view as a risk management exercise. Still burning money, but I get some value of assurance in it. And also there's some thinking about, ESG can be a driving force of innovation, changing the way products, services can be conceived in your business. Is a way of creating long-term value. We shall explore this idea more later. And there's also problems with too many standards. When you search online, you see an alphabet soup of acronyms about ESG. And GRC, SASB, PRI, TC, TFCD, I'm not making this up. And with all these different standards, comparison of ESG performances between companies is extremely difficult. And rating agencies, to solve this problem for themselves, they use their own proprietary calculation methods to evaluate ESG performance of companies that they are rating. And lastly, there's also this troublesome problem of greenwashing, that corporations, they spend millions and millions of dollars in an effort to improve corporate image, and actually very little to minimize environmental and social impact in their businesses. With all these problems, the understanding and the adoption of ESG is very difficult. And doing ESG now is a lot like trying to navigate your way out from the middle of a maze. But with all these issues, there is a silver lining. So there's a silver lining. Most of us agree that ESG is generally a good thing to pursue, and increasingly business leaders, they have spoken out about the importance of ESG, and that leadership is very important. People like Larry Finn from BlackRock, Bill Gates from Microsoft, and many, many others are putting efforts behind this driving force of ESG. And there are also efforts on the way to harmonize ESG approaches and reporting standards. So despite of all these complexity, ESG is becoming increasingly important. We have to take action no matter what. We shall tell you how corporation can do ESG, but before we do that, there are some skeptics out there. So in the next few slides, I'm going to take you through why corporations should do social responsibility. Okay, some history. Milton Friedman, Nobel Prize winner in economics, he says in 1970 that the only social responsibility of corporation is to increase profit. And this is the traditional thinking of shareholder capitalism. It is certainly not wrong, but there are many problems with this argument. Most obvious is that investor, it assumes that an investor have all the information that it needs. Corporations are paying a fair share of tax to government, and also governments are doing a good job with environmental and social issues. In reality, the opposite of these are true. Investors are left in the dark, don't know what corporations are doing behind the curtain, and multinationals, corporations, they are not paying fair share of tax, shifting profit to low tax jurisdiction. And governments in the world, they are, some of them are not, they do not have the best interests of their people in mind, spending disproportionately very little on the welfare of their people. So many social challenges remain prevalent today. We talked about quite a bit before, so I list a few examples here. And corporations are increasingly seen not the cure of the problem, but rather than the cause of the problem. So Friedman's argument is now considered outdated. So hopefully I've convinced some of you skeptics out there to do something about it. So to embark on this ESG journey, how do we fix this? So there's two questions in mind. First is how to do it, and the second, how far should we go? Whichever way you want to do it, guiding principle, in my view, is echoing back what we mentioned earlier. Corporations should make business decisions taking consideration of the concern of their stakeholders. This includes, of course, shareholders, but not only shareholders, but employees, suppliers, environment, government, etc. And there's no absolutely right way of doing it, but I can tell you one sure way not to do it, and that is to lie about it. Remember, one of the shareholders is your employee, so what is disclosed outside is not matching inside. There's infinite ways that the public can find out. So to answer my first question, how to do it, I recommend share value, this concept of share value and methodologies. This concept accepts the traditional purpose of the primary goal of corporations should be making money shamelessly. And that's what corporations are good at. But at the same time, it proposes aligning profit with societal value. And they suggest a few ways of doing it: rearranging business processes, reimagining products and services. And they believe by doing so, even more economic value can be liberated as a result. So Tricor is also a founding member of Share Value Project Hong Kong, an organization that pioneers this concept in Hong Kong. So quite rightly, we should advocate their cause. And of course, finding a social purpose is easier said than done. Like asking someone the purpose of life, it is difficult, but not impossible. As in life, the older and wiser you are, the more likely that you're going to find a purpose. So similarly, ESG should be an iterative process that continues to improve as corporation matures. So the next question then, how far should we go? I want to talk about the acronym ESG. The acronym ESG, Environmental, Social, Governance. These three headings are only really useful when we talk about ESG as a reporting scorecard, a scorecard of what really is a corporate sustainability practice. So, so I like the broader context of sustainability. This is really the purpose of why we do ESG in the first place. And people will often use these two terms interchangeably. And so I've been also doing this throughout my talk. The simplest definition that I can find is the 3 Ps, planet, people, and also the profit. So planet being the finite earth that all people will live in, and people live in this finite earth, and on this finite earth, we consume resources, and this resources is scarce. There's not enough of it. So there's also profit. Profit is the economics of how we most effectively, efficiently allocate these scarce resources on finite earth by competing with trades. So, and with corporate sustainability, governance is always also an important element that glues the effort of the 3 Ps together. And also, most recently in World Economic Forum in Davos, they talk about the 4 pillars of ESG disclosure. It's also the 3 Ps plus governance. So with these concepts in mind, we can now ask the question, so how far should we go? There's no one-size-fits-all approach, but having a proper governance structure is very important. For example, forming a ESG working group that works with the management as well as other employees across multiple departments to gain an understanding of the areas of ESG the corporate is involved in and work out what exactly the ESG concerns are material. And with this ESG materiality works out, the working group can then periodically evaluate the reduction, the efforts, the reduction of negative impacts and any positive impact that the business can bring within these 3 Ps, advising the board, management, to strike a delicate balance between the 3Ps when developing their business strategies. Now we talk about how we do it, what material ESG areas that we can focus on. We now talk about the question of how far. Now I recommend the UN 17 Sustainability Development Goals. These goals are they serve the needs of the 3Ps globally, and they are very achievable for any corporations. And corporations can select a few of these goals that are relevant to them and set ESG target based on these relevant goals. So switching gears now, let's talk about the Hong Kong EX ESG reporting requirements that is effective for financial years beginning on and or after July 1st, 2020. So what's coming next is a list of key changes and potential pitfalls. There's quite a lot of changes, so I'll just read out the big headings. First, there's mandatory disclosure requirements, MDR. Now, merely saying that you are committed to ESG in the report is not enough. So issuers are required to recognize and make disclosure of their ESG governance structure within their organization and how this governance structure helps with the evaluation of material ESG issues and set targets and review these targets. And also the new guide requires the target setting of 4 environmental KPIs, 2 within the emissions heading, that is the air emissions, GHG emissions, and also the waste emissions. And the other targets within the use of resources heading, energy use, and water use. There's also the newly added climate change aspect, which requires issuers to evaluate the climate risk impact, and not particularly cumbersome, I think. Issuers can use, there's a standard for that, TFCD. Next, there's social KPIs. All previously recommended KPIs in the subject area B are now comply or explain, meaning that you have to do it. So issuers that were previously doing minimum disclosures, now they have to put extra effort to deal with these. And last but not least, ESG that are not issued together with the annual report. Now it is not required to offer shareholders a printed copy unless they request it. So this definitely is more environmental friendly. So potential pitfalls. For climate change, we see many issuers in the past going to the explain route, saying that climate change is not material, but until issuers have actually properly done an analysis on their financial impact related climate risk, there's really no basis of saying that. After the analysis, most probably the opposite is true. So don't just say immaterial and then just leave it at it. We mentioned the TFCD2. It's definitely, you can use that. For the MDR board statement, we also note that issuers are planning to do a boilerplate statement and thinking that this is enough. But this needs to be a statement from the board, not just a statement from the staff who compiles the ESG report. So therefore, there has to be some supporting document and some basis of issuing this statement. So prior preparation is crucial in this respect. And target settings, we talk about SDG. Potential problems is setting a target that's unachievable. So don't set a target too ambitious, and also the target review period should be sufficiently long, say 5 years, 10 years, so you don't run the risk of not achieving it. So that concludes my presentation, and there's a few questions that I would like to ask Eva. She's a very experienced professional in the areas of listing companies, and she knows a lot about the corporate disclosures. So, Eva.
Thank you, Alan, for the presentation. Yeah.
Welcome to Tricor seminar.
My pleasure,
Let me just start by asking you, you've been in the industry for decades now, and corporate disclosure is very accustomed to them. But ESG is sort of the new thing. So what do you feel ESG is in general?
I see. Yes, actually, the ESG is quite a new initiative for the Hong Kong listed company. Because when the Hong Kong Exchange, they make a requirement to do the ESG report about 2 or 3 years ago. And then our observation in the past few years, most of the listed company, they are doing the report mainly for compliance reason. So we can see that most of the report, they have the same information. It seems that they're coming from the same template. It seems that the company, they don't know what's the purpose to do the report. It's just because it's the listing rule requirement. But I have to say that we have to understand why ESG is so important. I still remember about 10 years ago, at that time, an investor told me that what is ESG? 10 years ago, it's quite a new concept in Hong Kong. Nobody knows what is ESG, but that was already very popular in Europe. And then this European investor told me that as an investor, we are buying the future of the company. And then, but most of the company, they mainly produce the financial statement. And financial statement is actually telling us what's happening in the past. So there's not enough information for the investor to understand the company. So that's why ESG report is a very important document for them to assess the outlook, the future, the potential business of the company. So ESG is a report about the future of the company, and this is the information the investor can rely on. Okay, so that is why ESG report is so important. And then because the company, they don't know the purpose of doing the ESG report, so that's why they don't put resources to prepare the report. And that's why we see that actually the information disclosed is not up to the requirement of the investor. So we have to look at actually what investor they want to see, what the information they're looking for. So I would suggest, first of all, the company need to do an internal review to understand any specific information that is related to the industry and also related to their company. Because I believe any one company are exactly the same. All the companies are very unique. So this is the basic information we have to look at, and then to do an internal assessment and then find out the unique nature of your company and then to prepare the report. That is my observation for the past few years ESG report. Yeah.
Right, thank you. There are two specific questions I want to ask you about. One is, I think you mentioned it's very important to do assessment of the company, but obviously there's some aspect that investor would like to look at specifically in ESG reports. So do you have any idea what are they?
Yeah, okay. So when we talk about ESG, actually it has 3 components. E is the environmental, and then S is the social, and governance is, G is the governance. And actually, as Alex mentioned before, and also as some speakers mentioned before, governance is the most important. All the investors, they will look at the governance structure of the company before they make their investment decision. So when we prepare the report, we have to make sure we disclose all the necessary information so that the investor, they can, based on this information, to assess the company's governance structure, and also if they have any question, they can have a contact person to answer their question. And then for E and S, for actually, I see that a lot of listed companies, they are making a lot of effort in disclosing the carbon emission. For this point, I would like to suggest that it depends on your business nature. For example, if your company is doing a service industry, for example, you are doing training business or you are in the education sector. So in this case, you are not a factory, you are not a construction company. So carbon emission may not be that important or material to you. So I believe we have to look at the business nature of your company and then disclose those information that is relevant and also material. It doesn't mean that you have to prepare 100 pages of report, because if you prepare a lot of information, but if this is not related or relevant to your company, that is actually is useless to the investor and also confuse them. So remain focused, and then to make sure the report disclosure are actually material and also related to your company's business nature.
Right, thank you. And my last question, a lot of clients ask me actually, because now ESG is such a big game now. So they want to get really good ratings on ESG. MSCI, they do a lot of ESG ratings. Hang Seng also has a ESG index. So any advice for them to get a better rating on these boards?
Okay, I know that there are lots of different rating systems in the market, and there's no particular one that is what we call well recognized. Actually, I think this is a good reference point for each company to understand what is their standard when compared with the peers in the market. And I think it's good to have some rating system so that you know where you are. But it doesn't mean that you need to follow any particular one. And I would like to suggest that when we prepare the ESG report, get involved your IR colleagues in your company, because the IRO, they understand what the investor they want to know. So in your report, then you can include all the information that the investor they're looking for. So so that the investors are happy with the report, and at the same time, it's also easy for the IRO to when they meet the investor, to communicate with them. Because if the information is not a proper information, actually we cannot say anything. So to make sure we can put all the related information in the report, it's better to include your IR colleagues with you when you prepare the ESG report. That's my recommendation.
All right. Thank you very much. A really true honor to have you today. And thank you.
Thank you. Thank you.
Thank you very much. Dear speakers, please stay on the stage, please. And thank you once again for your insights shared, Dr. Chen. And thank you very much for your information share, Alan. At this stage, may I invite Ms. Kanbi Siu, Executive Director, Business Services of Tricor Hong Kong. Please come on up to the stage and present our souvenirs to our speaker, please. Thank you, Ms. Siu. Thank you once again, Alan and Dr. Chen. Now, the next pair of speakers are Mr. Michael Shi, Managing Director, Trust Services of Tricor Hong Kong, and Mr. Arthur Chen, Chief Financial Officer, Futu Securities International Hong Kong Limited. And they're going to be sharing with us digitizing employee benefit trust platforms. Please put your hands together for Mr. Michael Shi and Mr. Arthur Chen.
Thank you, Tony, and good afternoon, ladies and gentlemen. This afternoon's topic is about employee benefit trusts, or what many of us know as, or refer to as the acronym EBTs, but it's also used interchangeably with the term ESOPs, or employee share option schemes or plans. So today, what I will do is I will talk about the traditional approach in terms of setting up and administering employee benefit trusts. And then Arthur will talk about the digitisation of this process. So you will be able to contrast the old traditional way of doing things and the new electronic digital way of doing things. So we're going through this transition now. It's only over the last few years that these new digital platforms have become available. And so we're sort of familiarising ourselves with this new process as well. So today what I will talk about is just quickly what an employee benefit trust is for those of you who may not be familiar with them. We'll talk about the reasons for setting them up. And then I'll quickly run through the process of operating and administering an employee benefit trust structure. We'll go through the timeline, life cycle, and then just give you some examples of some typical structures. So firstly, what is an employee benefit trust? And as I mentioned before, it's also known as employee share option plans, or ESOPs, as many people refer to it as. And basically what it is a trust that's set up to hold company shares, and they can be pre or post-IPO, and they can just be simply private company shares. They don't need to be listed company shares. And the reason for setting up these trusts is to award key staff who meet specific criteria. And I think if all of you know, I'm sure, and I'm sure all our senior management understand that the key to a success of a company, whether it's Tesla, whether it's Google, or even Tricor, the success of the company rests in the key staff, the key talent. And so employee benefit trusts have been used for many, many years in the US, in North America and Europe, but only in the recent years has it sort of caught on in Asia, and particularly for Chinese companies now. It's become very, very popular. So we have been seeing an increase in demand, particularly from Chinese companies and particularly from tech companies, where they are now setting up these employee benefit trusts to attract talent and also to retain talent, because as we know, especially for companies that are looking at listing, it's very, very important that they are able to retain their key staff, whether it's software developers, engineers, or whatever type of service it is, to keep them on through the whole listing process, and also to retain them and to make sure that they stay with the company after the company lists, because that's going to be the value in the company. And also, especially over the last couple of months, we've seen a significant increase in the demand for setting up these employee benefit trusts. And I think that part of the reason is because the stock market share prices have been a bit soft at the moment, and a lot of these companies have seen the opportunity to allocate shares when they're relatively cheap, transfer them into a trust to hold for the awarding to employees. And employee benefit trusts, as you can see, can take many different forms. Most common ones, it can be options, and it basically enables employees to be awarded with options at a discounted or low price, and hopefully after the company lists, that value will go up, but they will get the opportunity of exercising their options to buy those shares at a very, very discounted price. It can be shares in specie, in other words, physical shares, or it can be what we refer to as restricted share units, and I'll go through and explain a bit later on in the trust structure as to how these work. Another form is phantom shares, so basically the shares are not actually allocated, but the equivalent of shares are allocated, and when the employees receive the award and they're vested in them, they receive the cash equivalent of those shares in that particular company. So, as I mentioned before, it's a tool to attract and retain talent to companies and to reward them for their contribution to the company. It enables the employees to become shareholders in the company, so they feel that they have an interest, skin in the game in the company, and that their efforts will reward themselves as well. It also allows a company to retain a certain degree of control over the shares before those shares are awarded and vested to those employees. And most importantly for companies and for senior management is that until those shares pass on to the employees, they're able to exercise the voting rights. And so those shares can be kept in the pool, held through the trustee, and the voting rights can be exercised in a consolidated form. In terms of using a trust, because there are some schemes, share option schemes, which don't require the use of a trust, but the benefit of having a trust and an independent trustee is that, firstly, there's no conflict of interest. So the employees know that these shares or these interests have been set aside, held by an independent third-party trustee, and no matter what happens, as long as they satisfy all the criteria and conditions, that they will receive the award that they're entitled to through the independent trustee, and there's no conflict of interest. And in some cases, there may be some tax benefits as well, either for the company or for the employees. So the whole process in terms of setting up employee benefit trust, you'll see here that firstly, we start off with the collection of KYC documents. Then we set up the trust in terms of forming the employee benefit trust. Then we add the assets into the trust, whether they be shares or cash. And then the next step is the granting of the awards to the employees, selected employees. Then there's a day-to-day administration. And finally, when the employees satisfy the vesting conditions, the shares or the interest can be transferred over to them. And then finally, when the life cycle of the trust and the scheme finishes, that there'll be termination. So traditionally, these types of structures have a very, very heavily paper and hard copy oriented. I still remember the first employee benefit trust that my team and I set up several years ago. It was for 550 employees, and the amount of volume of paper, we had piles and piles of paper in terms of KYC. It was all done manually, and I still remember having to sign documents authorizing signing notices or awards or vesting of interests. I actually had to manually sign all those physical documents, and I think that our in-house legal counsel, Judy Wong, who's a very strong proponent in terms of environmental protection, would be horrified at the amount of paper that we went through and the number of trees that we would have killed. So with the development now of e-signatures, electronic signing, we're able to sign documents electronically now rather than physically. And also in terms of KYC collection of documents, the old way of doing it was everything had to be on paper. We would print them out, we would check, review everything, we would hold all the documents, and now we also have not only KYC but also FATCA, CRS compliance, all the additional paperwork that we need to do normally physically, and have the paperwork signed by the employees and the clients. So when we come to the formation of the trust, that's fairly standard, like an ordinary private family trust. There's a drafting of the trust deed and scheme rules, working with tax advisors, the lawyers, and the client in terms of working out what the terms and conditions are going to be, whether from a trustee's perspective it's going to work, whether from the client company's point of view it's what they want, and from a trustee's perspective whether there are sufficient indemnities to the trustee. So once we finalise that, again, it's physical signing of paper documents. and exchanging of those documents to the different parties and physical delivery of those documents. Then we come to the asset injection or the transfer of either cash, company shares, or could be a combination of both. Again, all the documentation for that is all heavily paperwork. In terms of fund flows, there's also additional paperwork as well if we need to have, for example, safe compliance if there are funds flowing in and out of China. And in terms of buying and selling shares, again, everything's all done physically with physical documents. In addition to that, the trust structures that you'll see later on, we typically use an underlying holding company. So there'll be an offshore company like a BVI company held by the trust, which then holds all the underlying assets. And again, all that documentation is done through hard copy paper. Then there's also potentially reporting to the stock exchange in terms of, for example, STI filing or any other regulatory requirements. In addition to that, there's also the CRS, FATCA reporting and annual reporting. Then we come to granting the actual awards and interest to the employees. All those decisions are made by the advisory committee or the board of the company, and that committee or the board gives instructions to the trustee, and again, these are all written documents, and with all the details of the employees, the entitlements, the interests, what the conditions are that they need to satisfy before they qualify for vesting, the schedule for granting and vesting of the interest. And then there'll be a series of notices that are issued by the committee and the trustee to each of these selected employees. They then need to physically sign an acceptance, agreeing to join the scheme, and then follows all the KYC documentation that we need to collect from the employees. Then when it comes to the vesting of the interest, again, heavily documented. We confirm how many shares have been vested or the beneficiaries are entitled to, that they have met all the conditions for vesting. And then we also will have an exchange of documentation for the employee to decide if they have a choice, whether they want to receive the shares physically or whether they want the shares sold and to receive the cash equivalent, or sometimes it may be a mixture of both. They receive a combination of shares and cash. So again, all of that is using paper documentation. One other thing to note is that for these employee benefit trusts, particularly for senior executives, for very, very high value shares, so for example, the directors of companies like Alibaba, Tencent, Xiaomi, or all of these very, very well-known companies, the senior executive will usually receive shares or awards in the millions of US dollars. So, when a company, especially when they're listing, for example, like Ant, when they do eventually list, those senior executives would become very, very wealthy in terms of either owning the shares or the cash equivalent. So quite often we see these types of senior executives setting up individual family trusts themselves where they may receive the shares in their own family trust. And again, all of that is paper documentation. We don't do any of that electronically. We have physical trust deeds. We have physical documents transferring those assets into the trust and into the underlying corporate structure. And in terms of the daily administration, the ongoing administration while the scheme is running, typically it may be 3 to 5 years or even up to 10 years. Annually, there's annual trust accounts, annual invoices issued for trustee fees or other expenses. We do an annual review. We update all the KYC of the employees. And there may be, throughout the lifespan of the scheme, we may add beneficiaries or remove beneficiaries if they've left the company. So there's also all of that additional documentation that's also done by way of hard copy paper. And then finally, termination. Again, that's all done by paper as well. So you'll see here just a very, very general, very simple timeline of the life cycle of an employee benefit trust. You'll see here that the board or the advisory committee has selected particular employees, and this particular employee A, his entitlement is 10,000 shares in this Hong Kong limited company, and the scheme is to run for 5 years. And those shares are going to vest over a 4-year period. So you'll see here that during each of those vesting periods, again, all of those steps are paper-based, and all the documentation will be all in hard copy, and exchanges of documentation, signing of documentation and everything. So again, heavy use of hard copy paper. So these are just some examples of our trust structures. This one is holding pre-IPO shares, and you'll see there that we have an underlying BVI holding company to hold the pre-IPO shares, where the company, which is the set law, transfers either cash or shares to the trustee, and we will hold those shares or use that cash to purchase shares for the benefit of those employees when they're awarded to them and when they vest to them. And these are just some other examples of typical structures. Again, listed company shares, very, very similar to the previous diagram that you saw. And this one here. Another thing is that with employee benefit trusts, they don't necessarily have to hold company shares. We have set up schemes where the companies want to put cash into the trust, and that trust is used to hold various types of investments. And those employees may either receive those investments eventually when they vest, or those investment funds may be used to buy company shares to transfer to those beneficiary employees. And then this is an example of a restricted share unit trust where we have underneath the BVI company effectively units that are issued to the employees, and each unit would be the equivalent of X number of shares in that particular company. And there will be a formula for calculating the value of those units that are awarded to the employees. I'll just pass on now to Arthur, who will now talk about the digital platform that's available to carry out most of the functions that I've just mentioned. Arthur.
Thank you, Michael. For people who are not familiar with Futu, basically we are one of the largest consumer fintech company based in Shenzhen. We have office in Hong Kong as well. Primarily, our core business is to serve these mainland retail individuals and also the Hong Kong retail individuals to use their offshore assets to trade in the Hong Kong and the US stock market. But 4 years ago, we also entered into this ESOP SaaS business. So fortunately, you guys may know that we were listed in the US NASDAQ last March. As a CFO, I lead the team for the IPO preparations. That 6 months was very painful, but also very enjoyable. The only lucky thing I have is I should say maybe I'm the only few CFOs in a listed companies who are not worried about ESOP business or ESOP the service. Because I deal with the bankers, deal with the lawyers, and also a lot of other service providers, but I don't need to spend the time on the ESOP side because our product manager and also our R&D team has already developed these platforms. So, as Michael mentioned before, you can see more and more Chinese companies, in particular in the new economy sectors, such as new energy cars, biotech names, and also TMT names, are frequently using the ESOP as a very important incentive tools to retain and also to attract new talents. And also the coverage of this ESOP program has not limited to the senior management or these top-level persons alone. It has already covered to many middle-class management and also many key R&D staffs. This has created big challenges from the ESOP management standpoint, as you need to deal with more and more peoples and more documents. And at the same time, we can also see there are more and more companies need to raise more monies before they can come to the IPO stage. In this sense, you can see their cap table has become longer and longer before the IPO stage. It also created challenges from the company perspective, how to calculate and also how to manage your cap tables in a right manners. So this is from the company's perspective. You can see more and more people, in particular in the HR and also the financial functions, spend a lot of efforts in doing these documentations and try to take care of every employees. But ironically, from the employees' perspective, in particular these digital born generations, they actually have no ideas about this program means. In particular, they have no access to visualize this incentive and how responsible and how comfortable they can feel from this documentation process. And these are the pain points we find out in the past several years, including Futu ourselves. Before our IPOs and before we launch our ESOP business, we also used a very simple Excel file to manage and also to calculate these ESOP data for our employees. If you look at our ESOP platform, actually it lays down to two perspectives. Number one is from the company's management perspective. Easily you can see HR functions and also the financial function are the key functions or the key ESOP administrators to manage these data for the whole team. In our platform, these HR and also the financial colleagues, they can have the access through the web, through the H5 or even through the mobile to manage these data in a very efficient manner. And also, they can fully monetize the whole process of the employees from the granting to exercising, and also for the people to sell their ESOP stocks from the market. So it creates a huge efficiency improvement from the data management and also from the HR communication perspective. The other part is from the employee perspective. Before the IPO, actually a lot of my colleagues asked me, we have signed some contract about my ESOP programs, but I do not understand what this number means. Because for a US company's IPOs, before the IPO, normally the employees just granted for these ordinary shares. People actually have no understandings. There will be a certain conversion rate between the ordinary shares to the ADS. So people actually cannot understand this number means how much money they can make in the past 4 to 5 years. So here, actually, we try to simplify this process. And more importantly, for these millennial colleagues, we try to visualize the numbers they can see, how they can feel during these cap table calculations. All the numbers they have been granted can be automatically linked to the market price or to the latest round of private equity valuations of the company. So they can easily understand the incentives the top management have reward to them. Here, we also plug in colleagues, the ESOP accounts into their brokerage account as well. Because at the end of the day, once they want to exercise their options or RSUs, and they want to liquidate their positions from the stock market, they need a brokerage account. This is also one of our core business. But actually, we combine these two systems together into one app or into one platform. So people, they can easily see their ESOP numbers in their brokerage account. They do not need to, switch between two apps or two platforms to know these numbers. Besides this, the user convenience, we also spend a lot of time in terms of the KYC, CRS, FATCA, and also the tax regime. Once you can imagine, more and more Chinese companies start to go global, such as NIO, such as Xiaomi, etc. They also have a lot of expatriates or people based in Hong Kong, based in the US, who have been granted for these ESOP programs. This will create a huge challenges from the tax calculation perspectives. Therefore, we try to digitize these tax calculations based on our SaaS models. Once people key in their tax regime, it will easily calculate their tax burdens through our platform. They do not, not only the HR persons, nor these employees themselves spend a lot of time in terms of calculating their, the tax burdens. Also, we spend a lot of efforts in order to make sure all these, our clients be compliant with the CRS and also the FATCA reporting. Because it is very critical, and we ourselves, as a regulators, brokerage firms in Hong Kong, we need to comply with the SFC and also as a regulators regulation as well. Once we come to a SaaS service, I think the key questions in many clients' top of mind is the securities, because there's a lot of very important material personal informations, very sensitive data being stored in this platform. How we can ensure the data privacy and also the data securities. From our perspective, actually, we lay down the 4 areas which we think are very important. First of all, our service is a SaaS-based models. So all the clients' data have been kept in multi-servers spread into different locations, so that even there's some hiking in one servers, other servers still have a backup data. And secondly, we are very focusing on the data securities. We do normally a very regular data clearance and the security clearance to ensure these data being well protected. And also, you can see from the global perspective, actually a lot of third-party organizations have set up a lot of standards on the data securities, such as the ISO 27701, which has been implemented into the markets in 2019. It is a global standard, actually has comprehensive integrate a lot of regional standards in the US and in China altogether. And we are also very proud that we are the first Chinese service provider who have been awarded by this ISO 27701 standard in 2019. With that, I conclude my presentation. I think Michael and I are happy to take any questions if you have. Thank you.
Thank you. Thank you very much, Mr. Chen. Please stay on the stage, please. At this point, I'd like to invite Ms. Rita Lee, Executive Director, Corporate Services of Tricor Hong Kong. Please come on up to the stage and present our souvenirs to our speakers, please. you. Thank you, Ms. Lee. Thank you, Mr. Chen. Thank you, Michael, for educating us on how digitalization benefits employee benefits platforms. Now, the next pair of speakers who are going to come up here and share with us their expertise are Mr. Stephen Tran, partner, Mayor Brown, Ms. Judy Wong, Group General Counsel and CCO, Tricor Group. And they're going to be sharing with us the new regulatory regime for Hong Kong's private equity industry. So please put your hands together and join me in welcome Mr. Tran and Ms. Wong.
Wow, the lights are quite bright. Can you hear me? Good. So good afternoon, everyone. Hope now it is 5:15 Friday evening, afternoon. Hope you still have the energy to listen to this quite comparatively maybe boring to you. We are talking about law, limited partnership fund ordinance. So hope you all had an enjoyable, informative section this afternoon with us so far. This section is on limited partnership fund ordinance, and we are very pleased to have Steve with us, a partner of Mayor Brown, and he will do all the heavy lifting, talking about the law, and I will do the easy stuff. All right, so I'm sure that you have heard a lot of seminars, law firm write-ups on this topic, and this should not be a new one to you. And I hope that Steve and I today could give you a little bit more color on this ordinance and how we arrive at this to this stage right now. So today we will talk about what is the limited fund partnership ordinance, and Steve will of course share with you a little bit more detail on a comparison on the structure here in Hong Kong, in Singapore, and in the Cayman Island. And the last section that we would share with you is how lawyer Mayor Brown and Tricor as a CS corporate service provider can help you in this regime. Right, so this new law is, we are very excited to have this new law in place because the old limited partnership ordinance was enacted in 1912, and it was more than 100 years old. So it is a very high time to retire the old limited partnership and welcome a new one, the Limited Partnership Fund Ordinance. And this will enhance Hong Kong as an international financial center. We now have up-to-market limited fund partners regime that can serve the PE, equities, and other investor requirements. So what are why we have to retire our old limited partnership ordinance? Why we have to move into this new phase? So as I said, the old ordinance was more than 100 years old. It lacked the flexibility in capital contribution and distribution of profits. And it also lacked a straightforward dissolution. How it dissolved the limited partner is quite troublesome in the old days. So Steve will share with you how we can do it more easily under the new ordinance. And also, the contractual freedom among the partners are very limited, very restricted, very archaic. And also, the worst thing is they have to charge a capital duty on all the contributions of the LP fund. This is not attractive to investor and LP and GP as well. And also, the liabilities of all the limited partners are very unclear, and the GP is not clear under the old ordinance. So it has the investor hesitate to set up this limited partnership arrangement in Hong Kong in the old days. And also, the detailed information of limited partners are all public information. Of course, the investor would not want to have the information to publicly available for search, for inquiry, for everybody's knowledge. It is not attractive to investor at all. So what happened right now? So what are the differences among the new LPF ordinance, the Singapore ordinance, and also the Cayman regime? I will pass the floor to Steve, who will share with you a little bit more detail on the comparison of the three regimes. Steve, pass it to you.
Great, thanks, Judy. Okay, so let's skip a couple of slides. So we're going to talk about now the key features of the Hong Kong Limited Partnership Fund regime. So I'm just going to call it the LPF regime for short, and we're going to do it just by way of comparison to the other two fund regimes that are applicable and relevant here in Asia, and that is Singapore and the Cayman Islands as comparison points. So what are the key features of the new LPF regime in Hong Kong? What do we need to know about? First and foremost, the new Hong Kong regime is governed by the Limited Partnership Fund Ordinance, which Judy mentioned earlier. In Singapore, that is governed by the Limited Partnership Act and the regulations that apply under those laws. In the Cayman Islands, that's the exempt limited partnership law there as well. All three jurisdictions need a general partner. So you've got to have a general partner. In Hong Kong and the Cayman Islands, that general partner can be an individual or a body corporate or indeed a limited partnership itself. In Singapore, it cannot be a limited partnership. It must be either an individual or a body corporate. Legal personality of the fund, it doesn't have its own separate legal personality. So what does that mean? It means that the fund can only own assets and hold assets through its general partner, through its GP, and sue and be sued through the GP itself. So the fund itself is not a separate legal personality. In Hong Kong, as is the case with the Cayman Islands, you need to have a registered office here, right? In the Cayman Islands, you need to have a registered office there. In Singapore, you don't need to have a registered office, but you need to have a principal place of business. So just skipping through, so now we'll look at the regulatory authorities who are charged with regulating the funds. So, in Hong Kong, we have the Companies Registry, who are in charge of regulating the LPFs. It's ACRA in Singapore, the Accounting and Corporate Regulatory Authority, and in the Cayman Islands, it's the Registrar of Exempted Limited Partnerships. Judy mentioned before that the existing regime applies capital duty on contributions by partners. The new regime does not have that requirement, so that brings it in line with Singapore and the Cayman Islands, so we no longer have capital duty on the contributions of LPs. A great improvement. What about withdrawing capital and taking out distributions from the fund? Well, both across all three regimes, that is typically governed by the Limited Partnership Agreement, the LPA, that will decide and dictate how you withdraw capital and distributions. That's always subject to the fund itself being solvent, and that's the case for Hong Kong and for the Cayman Islands. In Singapore, there is an additional requirement that the general partner, the GP, needs to approve any capital and distributions from the funds. And that's typically built into the LPA anyway, but in Singapore, they make it a statutory requirement as well. So we talked about an LPA, a limited partnership agreement, and that really is the sort of the document that governs the relationship between the limited partners and the general partner. It's really the constitutional document of the fund. Across all three jurisdictions, Hong Kong, Singapore, and the Cayman Islands, parties are free to contract. They're free to decide what goes into the LPA. There's really no prescribed form, so you can adopt whatever form you like. The slight difference with the situation in Singapore is that there are certain default provisions set out in the Singapore laws that will apply to the extent they've not been overridden or modified by the LPA itself, right? But generally, across the board, the position across those three jurisdictions is fairly similar. You have to have an LPA, but there's no prescribed form. Right, so what about the GP? What is its role and responsibility? In a nutshell, and this is the same across Hong Kong, Singapore, and the Cayman Islands, the general partner has unlimited liability in relation to the fund. They also have essentially the ultimate control and responsibility for managing the fund as well. Now, uniquely in Hong Kong, our law requires the GP to appoint an investment manager, right, who has essentially the day-to-day sort of management for responsibility for managing the investment function of the fund. The IM, the investment manager in Hong Kong, needs to be either a natural person, a Hong Kong resident who's over 18 years old, or they can be a Hong Kong company or a non-Hong Kong company registered in Hong Kong. There's no such requirement across Singapore or the Cayman Islands. They do not need to have an investment manager appointed, only in Hong Kong. And in fact, the GP itself can appoint itself as the investment manager to simplify things. Okay, so what about the LPs? The LPs are simply just silent investors in many sense. They have limited liability, right? Their liability is limited only to the capital contribution that they put into the fund, that they've made to the fund. The exception is where the limited partners actually engage in the management of the fund. And that, that would then sort of remove their the limited liability status. Now, the new Hong Kong laws, and this is the same across Singapore and the Cayman Islands, contain a fairly good and also a non-exhaustive list of some safe harbors. So actions and activities that limited partners can do which would not cause them to lose their limited liability status. And so that's now entrenched under the new Hong Kong regime. It's reflective of what's in Singapore and the Cayman Islands as well. Okay, so some of these sort of logistics and admin around managing and running a fund. In Hong Kong, we have there is a requirement for the general partner to ensure that the assets of the fund are properly held through appropriate custodial arrangements. We need to also appoint an auditor to audit the fund every year. There's no particular requirements in relation to administrative aspects of managing the funds other than typical anti-money laundering, counter-terrorism financing, so KYC stuff that applies. Where, however, the fund manager is licensed by the SFC here in Hong Kong, then there may be additional custody, administration, and other audit requirements that apply to the fund manager as a licensed person. Similar situation in the Cayman Islands. In Singapore, also a similar situation as well, where the fund manager in Singapore is registered or licensed there, then there may be additional requirements as well. Oh, I should make the point that in Singapore and the Cayman Islands, there's no requirement for custody, administration and audit under the law other than in those certain circumstances that I mentioned with a licensed fund manager. Okay, so sometimes the limited partner may want to transfer their LP interest to somebody else. Across all three jurisdictions, that's typically set out, the process and mechanism for transferring LP interest is typically set out in the limited partnership agreement. Again, across all three jurisdictions, no stamp duty is payable on the transfer of limited partnership interests. In the Cayman Islands, the transfer is also required to be approved in writing by the general partner, and that's a statutory requirement under the Cayman law. There's no such statutory approval requirement in Hong Kong or Singapore, although the limited partnership agreement may build that in as a contractual matter between the parties. Dissolution, what happens when the fund is sought to be wound up and dissolved? Typically, and this applies across Hong Kong, Singapore, and the Cayman Islands, that is dealt with in the LPA. So typically the parties can decide when to dissolve and how to dissolve under the terms of the LPA. They can also request a dissolution by court order under certain circumstances. But in all cases of a dissolution, there will be filing and notification requirements, statutory ones that sort of kick in. So the same approach across three jurisdictions. Importantly, what about information on the limited partners? Is that publicly available? Across all three jurisdictions, no. LP information is not publicly available. However, information on the fund itself is. Information on the general partner is. And in Hong Kong, information on the investment manager is, as well as any authorized representatives that are appointed in connection with the Hong Kong fund. So there are additional disclosure requirements in Hong Kong that don't exist in Singapore and the Cayman Islands. Migration can you transition an existing fund that you've created under the old law onto the new regime? In Hong Kong, that's only possible with pre-existing limited partnerships that were created under the existing limited partnership ordinance. There weren't many of those actually in the context of private equity funds and similar investment vehicles. So, this won't really be relevant in practice. But at this stage, you can only migrate over domestic funds. That's also the case in Singapore, although there is word that the laws in Singapore may well be modified and reformed to allow migration of offshore funds onto the Singapore regime. In the Cayman Islands, much of the same situation, although there they do allow migration, so the moving on onto the Cayman regime of certain fund-related entities that have been incorporated in other jurisdictions, in other foreign countries outside of the Cayman Islands. So that's it in a nutshell as to what the key sort of characteristics of the new Hong Kong regime are. We're going to now jump into how Mayor Brown and Tricor can help everybody here, and indeed sort of fund managers and participants in the market who are thinking of setting up a new Hong Kong limited partnership. I'll hand over to Judy in just a second to talk about the amazing spectrum of services that Tricor can provide in that space. But from Mayor Brown's perspective, to kick things off, we can help from the very initial stages of fund formation. So while Tricor will be involved in pulling together all of the statutory and prescribed documents to form the application pack that gets submitted, the law requires that the application itself needs to be submitted by a law firm or a Hong Kong lawyer. And so Mayor Brown, we've been a Hong Kong law firm for about 156 years now. We can certainly handle the submission of the application. We can also handle the actual fund formation and fundraising aspects of an LPF, and that means we'll draft the LPA, the Limited Partnership Agreement, which is the key document. We can draft the Investment Management Agreement, which is the other key document, and typically you'd have a PPM, a private placement memorandum, kind of like a prospectus to issue to your investors. We can draft that as well. We can, of course, also assist throughout the general partners' negotiations on those documents with their limited partners. And indeed, if you happen to be a limited partner who's looking to invest in a Hong Kong LPF, we can support the limited partners in their negotiations against the general partners as well. Obviously not on the same deal, but in different circumstances. And similarly, every aspect of the fundraising process we can support and help. Once the fund has raised capital, we can help you to spend it. And so we can help with the downstream acquisitions and investments that the Hong Kong Limited Partnership Fund will invest in. Everything from the documentation through to help on the negotiations and the acquisition itself. And indeed, once you've invested and bought companies with your money, they become your portfolio companies, and we can help to serve all the legal needs of those portfolio companies as well. We're a full-service firm. We've been doing it for a century and a half, and so that's a space that we are very, very happy and able to support in. And obviously, all private equity funds typically exit from their portfolio company investments over a period of time, and we can certainly help with that exit as well. They're typically done via a trade sale or an IPO, and Mayor Brown has those areas of specialty and expertise to support in the exit process. So everything from the incorporation and establishment right through to the deployment of capital and right through to the exit as well. Over to Judy for Tricor's areas.
As Steve mentioned, the application has to be submitted by a lawyer. Even though the application has to be submitted by a lawyer and drafting of the memo and the partnership agreement, of course, have to be handled by a lawyer, but how can a company secretary help? We can help to set up the company. We provide compliance services, regulatory compliance, annual compliance, register office. But I want to flat out one point is, even though a lot of the heavy duty will be done by a lawyer, but it is important to engage a company secretary, of course, like Tricor, as early as possible, because we can work closely with the law firm to structure your corporate structure to make sure that all the KYC are in compliance, and we don't have any last-minute surprise that will affect the launching of your limited partnership or the funds. So it is important to engage a quality corporate service provider as early as possible, so we can help you to structure your company, whether you want to have a Hong Kong holding in Cayman, Hong Kong-based registered office, or how you want to structure it. Together with the lawyer, we can work together to put in a structure that best fits your funds requirement. So we can help to set up the company. We can help to, if you don't have a place of business in Hong Kong right now for the GP, we can offer registered offices services as well. And also the maintenance of a register, and also the annual compliance, company secretarial work, all can be done by a quality, the corporate service provider. So as I said, even though the documents and legal requirement would be handled by law firm like Mayer Brown or other law firm of your choice, but it is very important, as I said, to have a corporate service provider to guide you through and to work together with the lawyers as the process go on, so we can have a smooth launch when the fund is ready. So this is all of the presentation. Steve and I are happy to take any question you have, whether you want to raise it now or after, we'll stay behind. So we are happy to take any question you may have. Thank you very much. Thank you.
Thank you, Ms. Wong. Thank you, Mr. Tran. Mr. Tran, could you please stay on the stage, please? At this point, I'd like to invite Ms. Amy Ho, Executive Director, Corporate Services of Tricor Hong Kong, come up to the stage and present souvenirs to our speakers. Thank you. Thank you once again, Ms. Wong and Mr. Tran, and thank you, Ms. Ho. Now, time flies. For our last presentation for today, well, last but not least, the pair of the speakers coming up following are Mr. Christopher Louis, Manager Tricor Hong Kong, and Ms. Rainbow Chang, Manager Tricor Hong Kong. And what they're going to be sharing with us is the next imperatives as company secretaries in the era of pandemic and digital transformation. Please put our hands together for Christopher and Rainbow.
Hi, everyone. Thank you for staying with us. As Chris and I are standing between you and your weekend, we wouldn't want to keep you long. Hey, Chris, COVID-19 has changed our daily lives a lot, hasn't it?
Certainly, Rainbow. COVID-19 has made a significant impact to businesses and people around the world. We had travel restrictions, we had prohibition of group gatherings, and we had lockdown in some part of the world as well. This greatly reduced the economic activities and caused business disruption. People are forced to work from home and to continue their business activities, mainly online, without selling food outside. While these are supposed to be temporary measures to fight against the COVID-19, perhaps some of these measures are going to stay with us when the pandemic eventually ends.
As a result of these measures, we saw companies being suspend or reduce their operating capacities. This in turn lead to liquidity and cash flow issues for companies, and some may even close down their businesses, such as Cathay Dragon, a tragic end to the well-known Hong Kong aviation industry legend.
Rainbow, what challenges have you faced at work during the COVID-19?
Well, one of the most difficult issues that our listed client faced was the carrying out of annual audit at the beginning of this year, especially for PRC-listed issuers. Due to travel restrictions and lockdown, uncertainties arose as to whether this annual audit could be completed for the release of final results within the prescribed deadlines. We, as company secretaries, had to liaise with different parties and regulators to ensure compliance with the annual reporting requirements and meet the AGM deadline. You know what? More than 20% of the listed companies could not meet the deadline in March this year. While we have to ensure meeting the reporting deadlines, we also have to make sure our day-to-day managerial procedures and corporate governance practices are being properly followed. It was really stressful.
Another difficult challenge, you may agree, was the difficulty in conducting board meetings and general meetings. We observed that boards are meeting much more frequently, mainly to assess the impact on its business caused by the pandemic, but also to monitor closely on the implementation of the business continuity plan.
Yes, listed issuers are always reminded to update shareholders and potential investors about the impact of pandemic on their business and financial performance by way of announcement or in the form of financial reports.
Also, the government's social distancing measures have presented lots of challenges to company secretaries in organizing and conducting its general meetings.
Chris, companies have also encountered challenges in executing documents and agreements physically or remotely. A frequent question from our client is that directors have already signed the documents, minutes or resolutions, but can they simply return the scanned copy to us instead of originals?
Well, it will depend on whether the company's constitution provides such arrangement. But it shows that we have been facing some issues in managing the board operation and meeting procedures. To help with these, a greater portion of work has now been moved onto the online platforms that facilitate digital connection, such as video conferencing tools and messaging apps. It's important to be aware of how this application may impact a company's data privacy and security going forward.
On the other hand, I think the biggest challenge to the business sector is cash flow management. COVID-19 has created an unprecedented business liquidity issue. Managing cash flow problem and ensuring business viability in the long term are crucial for CEOs and CFOs. Some companies will be compelled to undergo restructuring. We, as company secretaries, should be capable of dealing with issues in simplifying group structures for the purpose of streamlining operations.
So how could we assist our clients to respond to the challenges brought by the COVID-19? To me, technology has played a crucial role in keeping our society functional in times of lockdowns and quarantines. In the pandemic era, Rainbow, you must agree that technology is the key driver in transforming our daily lives, as well as tackling challenges brought by the COVID-19. We are now experiencing a digital transformation, with technology has undoubtedly improved the efficiency in management of our companies. In terms of business resilience, cash flow is often a company's focus. Group restructuring may become necessary when companies are looking for ways to minimize its operating costs. Conducting group restructuring in a cost-effective manner is the next imperative for CFOs and company secretaries.
Couldn't agree more. So here we would like to share some imperatives for company secretaries in the following two important aspects. Firstly, in respect of the management of board and general meetings, we have imperatives to utilize technologies to improve management of board meetings, utilize technologies to empower general meetings, and modernize companies' constitution to keep up with digital transformation. Secondly, in respect of corporate restructuring for business to be resilient, we would like to highlight some cost-free restructuring options for simplifying group structures and cutting operating costs. Chris, how to improve board meeting management digitally is one of the imperatives that a company secretary needs to consider. As mentioned in the earlier sharing session, Board Portal greatly facilitates your board meeting management.
We can make use of Board Portal to organize and manage our board and committee meetings. It makes board meetings easier and also enable collaboration between the board members and the management with reduced carbon footprint, which originally came from traveling and printing. So virtual meetings have become the new norm for boards. Company secretaries should establish good practices for virtual board and committee meetings. To keep record of the meetings, we have resolutions and minutes. But how can the board members sign the minutes and resolutions during the lockdown?
To overcome difficulty in obtaining signatures, electronic signatures is the answer. We should consider the use of electronic signatures as tools for business and decision-making of the board. It will no doubt speed up the workflow. However, you should be reminded to check your constitution to ensure that there is provision allowing board resolutions to be signed by directors electronically. Also, to identify which documents that can or cannot be signed electronically.
Now, let's revisit how listed issuers conducted their AGMs during the COVID-19. Most of you should have gone through the period facing challenges of organizing and conducting your AGMs in the past 10 months, facing certain restrictions. For example, you had to arrange multiple rooms for meetings, to perform pre-registration and balloting, to arrange webcasts or video conferencing, or to arrange hybrid AGMs.
You should by now be quite familiar with the precautionary measures taken at the AGMs. Wearing face mask, checking body temperature, filling in health declaration, special seating arrangement. What's more, no food and drinks, and no distribution of corporate gifts. But no worries, we do have souvenir today. Don't forget to take the goodie bag before you leave.
From the COVID-19 experience, we have seen a transformation in conducting general meetings using technology. Traditionally, general meetings in Hong Kong are held physically. Hong Kong Companies Ordinance allows meetings to be held at one or more physical locations. To facilitate directors and controlling shareholders' attendance, it is common for listed companies to use webcast conferencing or video technology for the meetings. However, for both formats, no e-voting is allowed. If you are a proxy one to vote at a general meeting, you will need to attend in person. As the COVID-19 pandemic continues, many listed companies, MNCs, or NGOs, they are exploring how best to conduct their upcoming AGMs in light of the government regulations. There is an obvious growing trend of holding hybrid meetings among Hong Kong listed issuers. With the use of technology, hybrid meeting allows shareholders, whether attending in person or attending online, to vote for the resolutions, just like what our voting has done today.
Let's move on to see how technology could empower general meetings. Globally, companies have witnessed increased shareholders' participation when e-meeting and e-voting are in place. A good e-AGM solution, ranging from e-proxy, hybrid meeting, and e-voting system, helps the conduct of AGM and provides value to your company. Shareholders are given two options at a hybrid meeting: either attending and voting at the AGM in person, or watching the live webcast and voting online. e-AGM digital solution also offers an efficient way to assign proxies and increase participation in AGM virtually. But one thing to bear in mind: companies considering hybrid meetings will need to consider the logistics of managing remote communication and participation. We trust you have enjoyed our spot system for our hybrid meeting today.
Rainbow. COVID-19 has accelerated digital transformation. Company secretaries must equip themselves for holding electronic board meetings and committee meetings, with such arrangement becoming the norm. Another important imperative is to review and amend the articles or bylaws of the companies to allow for electronic meetings and votings.
Absolutely. There were questions from my clients as to whether a company could hold a hybrid general meeting if its articles have not provided for this.
Well, this will depend on what the company's own jurisdiction, the jurisdictions of laws provide. But also, the articles should be checked to ensure that it doesn't in any way restrict the holding of meetings electronically.
Well, I always suggest my clients to be prudent and take the opportunity to amend and modernize their articles or bylaws to facilitate hybrid meeting or virtual meeting. Some of our clients, such as Budweiser and Yoki Optical, have taken initiatives to amend their articles for this purpose at this AGM this year.
So Rainbow, what aspect you think we should pay attention to in particular?
To empower general meetings, provisions should be in place to empower the board to determine and change the format of general meetings. Whether members participating by electronic means shall be counted as quorum, and more important, whether technology failure at any meeting locations other than the principal meeting locations will affect the validity of the meeting. Also, the articles or bylaws normally require submission of proxy in writing or in physical form. Companies should also consider making necessary amendments to enable shareholders to submit their proxy form by electronic means.
As more countries impose travel bans, and also in view of the government's prohibition of group gathering, some companies may wish to postpone or adjourn their AGM or EGM. This is another situation that the company secretaries often encounter.
Yes, if you recall, when the prohibition of group gathering regulation was introduced in March this year, some of the listed issuers were going to hold their shareholders' meeting right after the regulation becoming effective. They were requested by Stock Exchange to issue an announcement to clarify if they will proceed with the general meeting or not. For example, Alibaba Health had at that time issued an announcement saying that they will proceed with the special general meeting, but they will just hold the meeting for the sake of putting a resolution to adjourn it. Sounds troublesome, right? Chris, actually, can a company legally postpone a general meeting, like in the event of typhoon or extreme weather condition?
Well, Rainbow, under common law, it is not possible to postpone a meeting once a notice has been given. The only way to do it is to hold the meeting and adjourn it. However, a company's articles may give the board the power to postpone a general meeting, where it is unreasonable or impractical to hold it at the appointed time, date, or venue. But you may note that articles of many companies do not provide for this.
You raised a very good point, Chris. So listed issuers should really consider making necessary amendments to their constitution to empower the board to postpone general meeting.
Do your articles or bylaws contain adequate provisions to empower your general meetings. It is time to review your constitution and modernize it to align with the international trends. Also, you may take this opportunity to check whether your existing constitution keeps track with the ever-changing rules and regulations, such as the change of PLC regulations on the notice period for general meetings in 2019, the enactment of the Hong Kong Companies Ordinance in 2014, and nevertheless, the related amendments to listing rules which trigger the need for amendments of Constitution. Amendment of articles of bylaw can be a complicated assignment. Talk to your professional advisors for help. It's true that businesses, they are feeling the impacts of COVID-19 and may as a result need to consider certain level of corporate restructuring. For instance, businesses are experiencing financial difficulties brought about by the COVID-19. Cash flow and liquidity become the main focus for companies, business, and its survival. Management must consider restructuring options in a cost-effective manner. We will now discuss how companies can restructure their businesses and operations to reduce costs. Companies facing financial difficulties may consider harnessing these out-of-court options to stay afloat and to possibly avoid insolvency proceedings.
Chris, I know that there are several cost-free restructuring options available under Hong Kong Companies Ordinance, such as cost-free capital reduction, cost-free amalgamation, members' voluntary winding up, and deregistration. These options are faster and cheaper alternatives to the court sanction process. Let's go through these one by one.
Sure, Rainbow. First of all, let's look at the alternative cost-free procedure for capital reduction. It is based on the solvency test and it applies to all Hong Kong companies. Capital reduction is a viable option for companies which do not have distributable profits for paying future dividends. Also, for companies which capital is used to offset against accumulated losses. High-growth startups may also consider capital reduction to simplify and improve their capital structure to attract new investors. In comparison, this option is a faster and cheaper option than the court sanction process. So, what is amalgamation? It is a legal process under which the assets and liabilities of two or more Hong Kong companies, they merge and are brought under one of the original companies. It can be in a vertical form or in a horizontal form and subject to the solvency test and other conditions. The introduction of the cost-free amalgamation also makes it easier for group companies to restructure and streamline businesses within the same group.
Now, let's look at different ways to eliminate some group companies. If the relevant Hong Kong company will ultimately not be needed, disposing the company through members' voluntary winding up may allow a return of surplus assets to the company's shareholders in a more tax-efficient and cost-effective manner, while deregistration is even a faster and cheaper way for disposing a company subject to conditions. From our own database of client companies, up to late October, we have seen a 45% rise in deregistration comparing with last year, and a 7% rise in liquidation. The figures will probably increase further by the end of this year. Of course, it is a rather small sample size, but it shows the general business environment that we are in.
Rainbow, before we finish, I saw some questions being raised to us. Let's look at a few of them and see if we can answer it.
Okay. Sure, Chris. This question is about solvency statement. Is auditor's report required to be attached to the solvency statement, and why?
Well, no, the auditor's report is not needed to be attached to the solvency statement. It's because that the directors of the company should know better than the auditors in terms of financial position, so it's not required.
The second question is about capital reduction. From the director's perspective, what should they consider before proceeding with the capital reduction?
Well, the directors should consider the potential financial impact of the capital reduction, especially on its cash flow. The directors should also consider that whether there are any special reasons that the company has to keep a large amount of capital. And also, whether they have any long-term planning to do with the capital will also affect what they want to do with the capital reduction. So I here have another question. If the company is not going to return the reduced amount to the shareholders after the capital reduction process, any other options for the company to deal with the money?
They can keep the reduced amount in the reserve account for future use, for example, as dividend.
We probably have one or two more questions. So we talk about e-signature. So in contrast, somebody wants to know what documents must be signed in wet ink signatures. Well, there may be a lot of them, but we try to give a few examples. You have any, Rainbow?
Statutory declaration?
I know that the issue of transfer to be submitted to the stamp office, that has to be signed with wet ink as well.
Right.
Any more?
How about audited financial statements? It must be submitted to the IRD with the PTR, profit tax return.
Oh yes, I had clients submitting a scanned copy, and they get a return letter saying that they need to resubmit an original one. So one last question here. It's about e-signature as well. So do we need to print the minutes and resolutions, sign electronically, and keep hard copies in the company kits? What do you think, Rainbow?
I think we should keep the original in the minute book for proper record keeping.
Right, so that we won't be like having one with wet ink and then left out the e-signature one, and so we to ensure that we have a complete record in our company kit.
Yes.
So that's it for the Q&A part.
To wrap up, no one knows when the pandemic will come to an end, but we should not just sit and do nothing. There must be something that we can do, no matter operationally or structurally. We shall always make use of technology, seek professional advice, and act ahead. That's all for our sharing today, and thank you for joining us.
Thank you.
Thank you. Thank you, Rainbow. Thank you, Chris, for sharing with us how corporate secretaries can more effectively navigate through the challenges at the COVID era. Now, we have come to the time, and please allow me a couple of minutes to wrap up for the seminar this afternoon. First of all of our speakers have spent enormous amount of time and effort in preparing the information that they shared today, and all of the presentations are done with extremely high quality. So at this point, may I invite everybody in this hall, as well as the online participants, please join me and give a round of applause, big round of applause to all the speakers today. And for those of you who are here, thank you very much for making presence today. You being here means a lot to us, and it's extremely difficult in light of the situation we're facing. So thank you very much, and we sure do hope you enjoyed this afternoon with all the presentation, all the information given, and hopefully they're inspiring and rewarding for you. Now, we would love to hear from you on how we're going to continuously improve our seminars for the years to come. So please do log on to our seminar mini site, fill out the evaluation forms through which you'll be able to get your CPD points. And one last time, please don't forget to drop off your name badges on your way out at the collection box for your certificate of attendance. Ladies and gentlemen, it certainly is my honor to spend this afternoon with you all here. And thank you very much. Enjoy a splendid weekend to come, and we'll see you next time. Thank you very much. Thank you.